We will now move to the major order of business for the day, which is our scheduled hearing on the question of automobile insurance, the affordability and the availability. Our minority members are on their way, but in the interest of conserving the time of our witnesses, they've suggested that we go forward with us, and other members of the committee will be joining us through the course of the morning. I'd like to welcome all to our subcommittee's second hearing on a problem that is close to the heart, or more accurately, close to the wallet, of millions of America's motorists. The rise in automobile insurance rates in recent years has been dramatic. We wanted to bring in a motorist, if we could find one, who was happy with the automobile insurance situation. We have scoured the land and have not been able to find anybody. Motorists are growing increasingly angry and impatient, and I can tell you this from my own knowledge in my own state at town meetings that I go to. The frustration level is reaching the point of violence. They are tired of hearing about new programs or new policies or new initiatives that are designed to bring down rates, only to find out that rates continue to go up, notwithstanding the indications of new initiatives. When a watch needs fixing, you have to take it apart. And that's what we're going to do with the insurance industry and the insurance dollar in the course of these hearings. We're going to try to examine piece by piece the aspects of this problem and see if we can uncover suggestions for dealing with the problem. Today we will focus on one part of where everyone's premium goes: automobile repair costs. In later hearings, we'll look into other major factors, like medical and legal expenses. For every dollar paid to an insurance company, an automobile insurance company, about 35 cents stays with the insurer for overhead and profit. The rest is paid out in claims, and that includes at least 31 cents for automobile repairs. Of that, 65 cents that gets paid out. 31 cents doesn't sound like a lot of money, but when you add up those 35 cents pieces, it totals about $25 billion. And insurance companies spent at least that much, and perhaps more, in automobile repairs in 1986. We will hear today that the amount of money spent on auto repairs is by no means uncontrollable. Safety features such as a well-run state inspection system, better driving, and auto theft practices, a reduction in the number of alcohol and drug-related accidents, and cooperation between the people who design automobiles and the people who have to fix them, all can help in trying to cut down costs. There are a lot of possible places to make the system more efficient and less expensive. But one thing is certain, that we have not found anyone who's willing to come forward and say, blame me, it is my fault. We have a situation where we have finger pointing at each and every other part of the total process. The lawyers blame the doctors blame the auto repair people, insurance companies blame everyone. This is not a situation that is sustainable. That there's no question about the fact that the 50 state car insurance systems that we have are in need of close analysis. One thing that would help as a first step would be accurate information about the various components of the system and how they operate in the 50 different systems. Information about accidents, information about their causes, information about the true costs of insurance. The last time that a non-industry group did a thorough study of car insurance, President Nixon was in the White House. That was in 1970. So it's clear that there's a need for an updating of some of these basic factual pieces of information. Nor has Washington done motorists any favors by some of its actions. For example, lower standards for auto parts resistance to crashes has not been a particularly helpful area. With today's rules, a collision at 5 miles an hour can mean $3,100 in bumper damage to a Honda CRX. And we have unfortunately been moving in the wrong direction in the last number of years. I look forward to hearing today's panel to give us their views on the different aspects of this one component of the totality of the problem. And I hope that when we have finished these hearings, we will be able to solve some of the mysteries of car insurance. It's getting to the point where high premiums and the feeling of being ripped off are eroding confidence on the part of the public, not only in insurance companies and repair shops and doctors and lawyers, but also in the public officials who are supposed to be in charge of our governmental systems that are supposed to have some oversight capability into this area. I think that is the particularly unfortunate aspect of what we've seen in my state, and I suspect in other states from around the country. We will, by unanimous consent, keep the record open for opening statements from other members of the committee. But I would like now to move directly to our witnesses. We have four panels of witnesses. I would like the first panel comprised of Dr. Peter D. Loeb, Associate Professor of the Department of Economics of Rutgers University, and Mr. Brian O'Neill, President of the Insurance Institute for Highway Safety, to kindly come forward. Gentlemen, we welcome you to our committee. We're very pleased to have you here and look forward to your testimony. As with all of the witnesses before our committee today, statements that you may have will be entered into the record in their entirety, and you may feel free to proceed as you see fit in the manner most helpful to the committee. So, Professor Loeb, we're pleased to hear from you.
Mr. Chairman, members of the committee, good morning. I'm Peter Loeb. I'm an Associate Professor of Economics at Rutgers University, and I thank you for inviting me to discuss my research findings regarding the relationship between motor vehicle inspection and vehicle fatalities and accidents. I forwarded a report to your office, which I would like read into the record. In addition, I've prepared a short statement regarding my research, which I would like to read, after which I would be happy to respond to any questions. My research has been in the area of applied economics and econometrics, and I've been involved in investigating motor vehicle fatality rates and accidents since 1981. This topic has recently been of great interest to economists, public health professionals, and government officials, among others. Special attention has been directed to several policy-related variables, such as motor vehicle inspection, vehicle speed, speed variance, alcohol consumption, and the minimum legal drinking age. My comments this morning will be directed at the effectiveness of motor vehicle inspection in reducing motor vehicle fatalities, fatality rates, and accidents. My research in this area indicates that states with vehicle inspection have significant lower fatality rates in a statistical sense than states which do not have inspection. Furthermore, statistical evidence is found that indicates fatalities and accidents in New Jersey were lowered significantly after vehicle inspection was introduced in the state. How do we come to these conclusions? Let me not burden you with the mathematical technicalities, but rather discuss the general methodology employed in investigating these issues. An econometric model of fatality rates was developed and then estimated by regression analysis. The model includes a whole host of socioeconomic and driving-related variables which may have an impact on fatality rates. One of the variables investigated is that of inspection. The statistical procedure employed provides estimates of the independent effect of the various explanatory variables on levels of fatalities and accidents. In other words, the procedure allows us to estimate the independent effect of inspection in reducing fatalities and accidents. Cross-sectional data for the year 1979 were employed for 46 states in the District of Columbia. Many different specifications or variations of this basic model were estimated. The specifications differed from one another based on which explanatory variables were included and which were excluded. In addition, Specifications differed as to their functional form and how the dependent variable was measured. The coefficient associated with inspection, which indicates its effectiveness, was then examined. It's interesting to note that the coefficient associated with inspection always indicated that states with inspection had lower vehicle fatality rates than states without inspection. If the coefficient associated with inspection is stable, that is non-fragile and significant across the various specifications, as in the case examined, there is indication to support public policy acting upon this variable. If the model is considered a reasonable and likely to incorporate the true model or a reasonable facsimile, non-fragile results, stable results, while not capable of selecting the true model, will still provide confidence in the general results. My research has indicated, while using cross-sectional data, that inspection consistently had a negative impact on fatalities and fatality rates. Furthermore, the effect was statistically significant. I've taken the liberty of providing your aid with several of my journal articles which demonstrate the effect of inspection with greater clarity. In any case, my studies indicate that states with inspection experience conservatively 137 fewer fatalities per year than states without inspection on average. In addition to this fragility analysis, I've employed a set of specification error tests to examine many of the estimated models for specification errors. In particular, I've examined the models for errors such as the omission of important explanatory variables. Did I omit something of importance? Such an error would generally result in biased estimates. What that means that if you omit an important variable, the results which you would get with any of the remaining variables might be off the mark in general, and I was concerned about that. These specification error tests are powerful criteria for evaluating the veracity of the results suggested by the models. The specification test failed to reject any of the models investigated due to specification errors. In addition, an extreme bounds analysis was conducted on the basic fatality model. This could be viewed as a more extensive version of the prior mentioned stability or fragility analysis. Once again, we find the effect of inspection is non-fragile. Hence, fragility analysis and specification error analysis suggest that inspection has a statistically significant effect on reducing fatalities and fatality rates. In addition to examining the effect of inspection using cross-sectional study, a study was conducted on the effect of inspection in reducing fatalities and accidents in New Jersey. A regression model was evaluated for the period 1929 to 1979 for this state-specific case. Once again, inspection was found to have a significant negative effect on the levels of fatalities and accidents in New Jersey after accounting for the effect of a whole host of socioeconomic and driving-related variables as well as technology. The results were examined for fragility and found to be quite robust. In other words, the coefficients associated with inspection was always negative and statistically significant across all the models investigated. In terms of accidents, the regression results suggest that accidents are reduced in the neighborhood of 22,853 or more when inspection is invoked in the state of New Jersey alone. Specification error tests were also applied to some of these models, and these tests once again failed to reject the models examined for specification errors. Table 1, which I've asked to be distributed by your aid, provides some of these results. An examination of the statistical findings demonstrates the impact of inspection on reducing accidents and fatalities. And if you peruse them at your leisure, you'll find that the coefficients, the measure of the effectiveness of inspection, is very stable. Hence, both time series and cross-sectional studies find inspection effective in reducing fatalities, fatality rates, and accidents. This conclusion is reached using state-of-the-art econometric techniques, which are statistically powerful. Let me conclude my discussion with a few words regarding the partial costs and benefits of inspection. As with most things, inspection of vehicles is not a free good. We have estimated the partial cost of inspection in the state of New Jersey, using 1981 as a reference year, to be approximately $83.5 million. These costs include the costs of operating the inspection facilities by state agencies, the opportunity costs associated with time spent bringing vehicles for inspection and waiting during the inspection process, as well as vehicle usage costs associated with the inspection process. With regard to benefits of inspection, we note that motor vehicle accidents resulting in fatalities, injuries, and property damage impose financial and non-financial costs on individuals and society. These costs include the reduction of society's output, property loss, pain and suffering, medical expenses, which otherwise would not have been incurred had the accident been avoided. The avoidance of these costs due to motor vehicle inspection are benefits due to the inspection process. We have estimated the present value of the income stream of victims of fatal accidents in 1981 dollars, based on the work of Hartunian, Smart, and Thompson, as $271,454 per victim. Let me stress this is a conservative estimate. Most other estimates are significantly higher than that. In addition, we estimate the benefits of avoidance of property damage due to inspection. Our estimates suggest partial benefits due to inspection exceed their costs. Our estimates of benefits in New Jersey range from $86.36 million to $111.53 million, depending on model used, to estimate the losses as well as what is included in the calculation. For example, do we just include fatalities avoided? Do we just include fatalities and property damage avoided, etc.? As such, we find the benefit-cost ratio associated with inspection to be greater than 1, even when using conservative estimates of the statistical value of a life and without considering such items as pain and suffering. Hence, we are able to establish empirically that motor vehicle inspection has a significant negative impact on automobile fatalities, fatality rates, and accidents, and furthermore, that motor vehicle inspection appears to be cost-effective in the state of New Jersey. Thank you.
Thank you very much. Mr. O'Neill.
Mr. Chairman, members of the subcommittee, thank you for the opportunity to appear today. I am president of the Insurance Institute for Highway Safety and the Highway Loss Data Institute. These are two nonprofit research groups that identify, develop, and evaluate ways to reduce the losses from motor vehicle crashes. Both organizations are supported by property and casualty insurers. By far the best way to control insurance losses, and hence insurance costs, is to reduce the deaths, injuries, and property damage that occur on our nation's highways. This involves effective programs to influence the human, vehicle, and environmental factors in crash and injury causation. It's a long-term process without any quick or easy answers. For example, in the case of programs to make vehicles safer, the changes will take 10 to 15 years to filter into the entire fleet of cars on our roads. Although effective highway loss reduction programs can take a long time, the payoffs for them are significant. We've been applying the scientific approach for 20 years or so, and at least in part as a result, highway death rates on a per mile, per capita, and per registered vehicle are lower today than they were a decade ago. This means that the human tragedy of crashes is being averted. It also means we're keeping down the direct costs of medical care for motor vehicle crash injuries. These direct costs presently cost our society more than $4 billion annually. But as expensive as crash injuries are, relatively minor collisions account for most of the direct costs of motor vehicle crashes. About 33 million cars are involved in crashes annually, with vehicle damage totaling more than $27 billion. The Highway Loss Data Institute collects and analyzes insurance data on the number and extent of losses, theft as well as injury and collision or vehicle damage associated with passenger vehicles. The Highway Loss Data Institute is not in the business of insurance, nor does it publish information about insurance rates or premiums, but it does gather and publish detailed information about the injury, collision, and theft insurance losses of recent model vehicles. From the data that Hildy collects, or the Highway Loss Data Institute collects, we compute specific loss statistics for individual car models. These statistics include claim frequencies, which are counts of insurance claims in relation to the number of vehicles insured, and figures indicating the costs of claims. These statistics are based on collision, no-fault injury, and comprehensive coverages. We do not collect information or publish results on the various liability coverages. The Highway Loss Data Institute reported a decade ago that the average frequency of collision coverage claims, these are claims for vehicle damage, for for all 1976 model cars was 10.1 per 100 insured vehicle years. For 1986 model cars, the corresponding figure was 10.4. Thus, we know from these results that the frequency of insurance claims isn't changing appreciably. And you can see this from the blue line on the chart on my left, your right. Nor have crashes become more severe since the 1970s, because if they had, we could expect the frequency of claims for personal injuries to have increased. But it hasn't changed very much. As you can see from the green line on this chart, the average frequency of insurance injury claims was 21.1 per 1,000 insured vehicle years in 1976, and it was 22.4 in 1986. Not much of a change. What has changed dramatically is the cost of insurance claims, the cost of repairing the damage to people and property from crashes. Average loss payments for vehicle repairs were almost 3 times as high in 1986 as they were a decade ago, up from $637 in 1976 to nearly $1,800 in 1986, as you can see from the red line on the chart. We don't compute comparable averages for the no-fault injury claims because the upper limits on payouts for injuries vary substantially from state to state, making such computations very difficult to interpret. But we do know that medical costs, like vehicle repair costs, have risen dramatically since 1976. This cost escalation has had an obvious and crucial effect on the prices consumers pay for auto insurance. But there are other factors in addition to inflation that are affecting insurance losses. Important among these are the vehicles themselves, particularly their size. Small cars consistently have more injury and collision claims than large cars. This has been true for every year that the Highway Loss Data Institute has published insurance claim information. Furthermore, specialty models, these are sports or luxury cars, especially the European luxury and semi-luxury cars, also have very high collision losses. And because these cars represent a growing share of the nation's new car market, they have a larger overall effect on insurance losses than they did 10 years ago. For example, among 1976 models, small cars represented only 20% of the insured cars in Hilda's data files. Sports and specialty cars represented 10%. By the 1986 model year, small cars had gained in popularity, representing 32% of the cars in the Highway Loss Data Institute files. Sports and specialty models increased from 10% in 1976 to 15% in 1986. This national trend towards small cars and sports and specialty models is affecting insurance costs for motorists in some states much more than others. California, for example, has a much greater proportion of insured small cars, 44% of the fleet there, than does the rest of the United States, where it's 32% of the fleet. California has more insured sports and specialty models than the rest of the country. 22% in California compared to 15% for the rest of the country. These vehicle factors contribute greatly to the higher than average losses and hence more expensive insurance for many motorists in California compared to most of the rest of the United States. Another factor that determines insurance losses in addition to vehicle size and type is the location where the vehicle is often driven. Although very severe crashes, those involving death or serious injury, are more likely to occur in rural areas than urban ones, the situation is reversed for the less serious run-of-the-mill crash. These occur much more often in urban areas where traffic volumes are high. So insurance losses vary depending on the degree of urbanization and hence the frequency of motor vehicle crashes. As the population density increases, both injury and collision claims increases also. The chart to my right shows insurance losses in relation to population density as defined by the U.S. Department of Agriculture. What we see from this chart is that collision claim frequencies rise along with increasing urbanization. Also, you can see that in each category of urbanization, small cars have greater losses than large cars, with mid-sized cars falling in between. When we factor in the costs of these collision claims, in the next chart, oh, I'm sorry, it's up there. The middle chart you can see that higher collision payments per insured car per year occur in the most urban areas compared to the rural areas. Also, medical payment claims for personal injuries, the third chart on the far right, show that such claims are also much more frequent in urban areas than rural areas, but again, in every case, the losses are much greater for the small cars than the large cars. These kinds of differences, together with the high losses associated with small cars and sports and specialty models, for example, would mean that owners of small sports cars who live in big cities are much more likely than owners of family station wagons in rural areas to be involved in insurance claims for both injuries and vehicle damage. Such differences translate directly into higher consumer costs for insuring small cars in urban areas. It isn't surprising, given these findings, that motorists in some states are feeling the effects of insurance losses more acutely than motorists in other states. For the nation as a whole, 16% of the cars are located in the most rural areas and 52% in the most urban areas. But to cite California again as an exception, in that state only 3% of the cars are located in the most rural areas, where insurance losses are relatively low, and nearly 85% of California's cars are located in the most urban areas. And Mr. Chairman, in your state of New Jersey, the split is about the same. Virtually none of the cars in New Jersey are located in rural areas, while 85% are in densely populated cities and suburbs. In fact, New Jersey, California, and Maryland are the most urban states in our files. On the other hand, more than 80% of all cars in states like South Dakota and Wyoming are located and driven mostly in rural areas where the losses are less. Many of the crashes that occur in our urban areas are of the fender bender variety. That is, they occur at relatively low speeds, about the equivalent of hitting a solid wall at 5 miles an hour or less. Recognizing the huge costs associated with these kinds of collisions, the U.S. Department of Transportation issued federal bumper requirements beginning with the 1973 model years. The purpose of this and subsequent stronger bumper standards was to reduce or eliminate the costly damage to passenger vehicles in low-speed collisions. By the 1980 model year, all new cars were required to withstand 5-mile-per-hour front and rear into barrier crash tests with absolutely no damage. The consumer benefits of damage-resistant bumpers are clear-cut, despite claims to the contrary by the U.S. Department of Transportation officials. Fewer low-speed crashes cause damage of any sort. The costly and time-consuming chores of repairing cars after crashes is reduced. And in large numbers of the crashes where damage still occurs, the costs of the repairs are lowered by the better bumpers. Because so many crashes occur at low speeds, especially in urban areas, these benefits add up to huge savings in consumers' time, money, and aggravation, not to mention insurance costs. Despite the benefits, though, federal regulators bowed to pressure from automakers and rolled back bumper requirements from 5 miles an hour to 2.5 miles per hour for 1983 and later model year cars. Now remember, the 5 mile an hour requirement permitted no damage at all. The present 2.5 mile an hour requirement, not only has it been weakened in terms of the speed, it also permits unlimited damage in 2.5 mile an hour crashes to the bumper and its attachment hardware. This means that the present federal bumper standard is so weak that it's little more than a sham. Fortunately, the result of weakening the bumper standard has not been, as you might expect, uniformly weaker bumpers. What has been the result is widely varying bumper performance levels. Because of pressure from insurers and consumers, some manufacturers are today equipping their cars with bumpers that meet the previous 5 mile per hour requirements. That is, they substantially exceed the almost non-existent federal requirement. But unfortunately, many other manufacturers don't. And consumers, neither does the U.S. Department of Transportation, even though it promised to do so when bumper requirements were rolled back in 1983. So confusion reigns. To illustrate the wide variations in bumper performance levels, the Insurance Institute for Highway Safety each year conducts a series of low-speed crash tests. This year, we conducted a series of 4 5-mile-an-hour crash tests on 27 new 1988 small two-door models. The total damage in these 4 5-mile-an-hour tests ranged from a low of $382 for Ford's Escort EXP to $3,140 for Honda's Civic CRX. Incidentally, the 1981 Ford Escort passed all of these 4 tests with no damage at all. So we've gone backwards. And what I'd like to do is show some very brief videotape highlights of these and some other differences in performance. The videotape is rather short. First, we will see the Ford EXP, the best car in this year's tests, in a 5-mile-an-hour front into angle barrier test, where the damage was $53. Then a Ford EXP into a rear into pole at 5 miles an hour, more damage, over $300. Then the worst car in this year's test, the Honda Civic CRX, in the angle barrier and the rear into pole. And finally, just to illustrate the confusion, there'll be a split screen shot of 2 Mazda models. These are obviously made by the same manufacturer, but widely differing bumper performance levels. The Mazda 323 in this 5-mile-an-hour rear into pole test will have $374 worth of damage. The Mazda MX-6 from the same manufacturer will have over $1,000 worth of damage in the same test. Could we run the videotape, please? This is the best car in the 1988 low-speed series, the Ford EXP. $53 worth of damage in this test. This is the best car in our rear into pole test. Considerably more damage, $319. And this is the best car overall. The Honda Civic CRX was the worst car overall, as was the Honda Accord in the 1987 tests. $676 worth of damage in this minor low-speed crash, and in this one, $1,366. This damage is totally unnecessary. There is bumper technology to eliminate it entirely. The 1981 Ford Escort went through all 4 tests with no damage. Here's a car going into the rear to pole test with no damage, the Chevrolet Spectrum, illustrating that it can be done. Now we see the split screen, 2 cars from the same manufacturer. The car on the top, $374 worth of damage. The car on the bottom, $1,168 worth of damage. All unnecessary. And the consumer cannot find out when you're in the showroom. You have no way of knowing what the performance levels of the bumper systems from the various manufacturers are. Bumper performance isn't the only determinant of a car's insurance loss experience. Far from it. Losses are influenced by vehicle size and body style, as we've seen, by where the vehicle is operated, by the age and sex of the driver, and by a number of other factors also. But our research has shown that when other factors are constant, but bumpers are weakened, insurance collision losses jump dramatically. When the bumpers are improved, collision losses decline. This means that insurance collision costs go up with flimsier bumpers, and they come down with stronger bumpers. The fact is that across the board, insurance losses are driven by the consumer. The fact is that across the board, insurance losses drive the consumer costs of insurance. When the former go up, so do the latter. Insurance claims costs are increasing, largely because of the increasingly high price tags on medical care and vehicle repair. I think you'll hear from other witnesses today about some efforts by insurers to control some of the vehicle repair costs. Collision and no-fault injury claim frequencies, as one of the first charts showed today, haven't changed much in recent years. Neither has injury or vehicle damage severity, as measured by severity, not by the cost. For this good news, we can thank long-term highway loss reduction programs. However, because of growing traffic volumes, especially in our cities, as well as the growing popularity of small cars, sports cars, and luxury models, the prospect of continued stability in injury and collision claim frequencies isn't so bright. Thank you.
Thank you very much to both of our witnesses for very interesting and forceful presentations. Mr. O'Neill, let me just ask what I suppose is the logical question flowing from your presentation. Why is it that we wouldn't expect the insurance industry to do more in either specifically disseminating some of this type of information other than just through your institute, almost as a marketing mechanism? And why is it that we don't seem to have more selective pricing in accordance with the risks that you so impressively detail?
Let me address the
That
first
is,
part.
pricing of the insurance product in accordance with the risks.
With regard to the dissemination of the information, we do everything we can to disseminate both our crash test results and the results from the Highway Loss Data Institute as widely as possible. We work extensively with the media to get major exposure for these results, and they do get major exposure. But again, when it comes to the bumper results that you saw on the film and the results that are appended to the testimony, a few minutes exposure on the media interests the public, but it's not the same thing as having that information on the bumper sticker in the new car showrooms. That's when people need the information. So there's a problem there. The Department of Transportation, as I mentioned, had promised a consumer information program when it weakened the bumper standard, saying that the marketplace should determine the appropriate levels of bumper performance. The marketplace can only work if it's given information, and the present marketplace has no information.
Are there any of the constituent members that you represent, that is the insurance industry groups, thought through the desirability of pricing products in accordance with some of this type of information? I mean, it's almost as someone comes to the door to your local insurance agent and he wants to buy a Honda versus something else, or rather buy insurance for the cars. It may very well be that if the policies can be modified so this type of information gets out, it will then influence market decisions toward the end of arresting this trend that you very impressively pointed out.
Let me first say that my organization is not in the business of insurance. So everything I say about insurance pricing is what I've gathered from being associated with insurers. First, the Highway Loss Data Institute results are circulated extensively by large numbers of insurers through their agents to policyholders in very large numbers. We have a simple, unfortunately I don't have one with me, color fold-out that documents the injury and vehicle damage loss experience of individual makes and models that's produced every year and given wide circulation. And the circulation of that material is growing each year. When it comes to pricing, it is my understanding that virtually all insurers will price collision coverage, which is one of the most expensive coverages, as you know, based on the loss experience of the cars. So these results do get factored into the prices. And in fact, just a few months ago, General Motors publicly stated that one of the reasons the Pontiac Fiero was going out of production, this is a small sports type car that had very high insurance losses, was the cost of insuring that car. People were not buying the car, or many consumers were choosing not to buy that car because of the high costs of insurance. So the high costs of insurance for particular makes and models is having an impact in the marketplace.
Let me, before I ask Professor Loeb a question, just ask for your analysis of his analysis, in the sense that I note you talk about size of cars, complexity of cars, location of cars, the quality of the car. Have you done any type of models that would factor in this factor of inspections or the absence of inspections as a cost control mechanism?
Over the years in the Insurance Institute for Highway Safety, we've looked hard at the question of motor vehicle inspection, or periodic motor vehicle inspection. The literature on the subject is confusing at best. There are econometric models showing that periodic motor vehicle inspection actually makes things worse. There are econometric models showing that periodic motor vehicle inspection makes things better. I have not had the opportunity to look at Professor Loeb's study, and we certainly will do so with interest. The evidence is, I think, rather clear-cut that any benefits from periodic motor vehicle inspection are probably small. I believe they are probably positive, but I think they are relatively small benefits. They are probably going to, periodic motor vehicle inspection is likely to affect the frequency with which people replace tires, for example, so we should, in states with good inspection programs, have fewer motorists with tires that have outlived their normal life that should influence motor vehicle accidents in wet weather only. And that's one of the problems when you start to try to look at something like periodic motor vehicle in detail. The kinds of crashes that you expect to be affected by periodic motor vehicle inspection tend to be a subset, a relatively small subset of the overall totality of such crashes. I will, or we will at the Institute, look closely at Professor Loeb's study. I just want to point out that there is conflicting evidence in the scientific literature on the virtues of inspection. And as you probably know, the trend in recent years in many states has been to either eliminate inspections or to drop them from twice a year to once a year.
Let me ask Dr. Loeb, first of all, the basic term, inspection, obviously can be much different one place from the other. That in many areas, my understanding is that inspections in large measure are primarily environmentally oriented, that is air emissions inspections, as opposed to safety in the more traditional way of understanding that. I know in my own state, our state, some of the motor vehicle employees have been sort of writing anonymous letters to me saying that they're troubled by the efficiency that is being built into the system recently by virtue of scaling back the different components of the inspection, that in the interest of getting people through faster, they're not inspecting in the way that they had previously inspected. How do you use a constant to make your conclusions when inspection as a generic term is obviously not constant?
That's an interesting observation. You're absolutely right. The variation in inspection procedures from state to state is relatively large. New Jersey not only has inspection, but it has a choice of a state inspection or a private inspection, where the private inspection is viewed by the state. It's licensed as well. So New Jersey has I think, a very effective inspection procedure compared to many other states. What we've done is we've looked at New Jersey's experience from a period when New Jersey didn't have inspection to a period when it did have inspection, and we found that there was a significant decline in fatalities after adjusting for a whole bunch of other socioeconomic variables which could impact on the level of fatalities. For
like
example,
our change in drunk driving laws?
We've looked at arrests for alcohol, driving while intoxicated. We've adjusted for the amount of highways available. We've adjusted for speed, the average speed of vehicles on highways. And we've done the same thing across states. Now, across states you're going to have a great deal more variation as to what components are inspected. But we're getting the same effect. We're finding that there is a reduction, a significant reduction. And furthermore, the models are evaluated using a set of specification error tests, which is a procedure which is relatively limited in usage in most econometric techniques. The technique is very powerful. It asks, have you misspecified the model? Is there something wrong with your model? We have not found that inspection results in more fatalities. In fact, if you look at most of the studies, at least the ones that we've had available to us, which indicate a positive relationship between inspection and fatalities, you find that they're not statistically significant. In other words, they don't amount to a significant amount to worry about. That doesn't mean you shouldn't worry about them individually, because clearly if you're involved in an accident, it's something to worry about. If your neighbor is, perhaps it's less worrisome, especially if it's only a fender bender. In addition to that, we've evaluated these models using, as I mentioned, a form of extreme bounds analysis. We've asked what happens if you change the model, if you add things in, if you exclude things. The results change, and they don't. So we're fairly convinced that inspection does result in a reduction in fatalities and accidents.
Have you got the capability of breaking out non-fatal accidents as opposed to just evaluating fatalities? For example, if we had monumental success in new healthcare, respiratory systems, emergency response capability, such that fewer people are dying. That may be a desirable impact, but it may very well undercut the conclusion you arrive at. That probably, in terms of fatalities, being related to inspections. The incidence of accidents might be a better indication of the relationship between, hopefully the positive relationship between inspection and accidents.
The most recent study which we've conducted has looked at fatality rates and the impact not only of the variables which we've measured, but hospital access. And we found, even after adjusting for accessibility to hospitals, inspection still has a reducing effect on the fatality rate. Accidents obviously have increased over time. The number of fatalities have fortunately declined over time, and still the fatality rates are impacted by inspection.
Okay. Yield to the gentleman from Utah.
Thank you, Mr. Chairman. Dr. Loeb, I'm a statistician by trade, taught for 25 years at Brigham Young University, so I'm very interested in your study. But let me ask you a couple of questions. First of all, how long has New Jersey had its state inspection laws?
It's been in effect since 1938.
1938. And fatalities have dropped. Would you compare the accident rate after 38 with that before, as far as New Jersey is concerned?
That's correct, as well as fatalities before and after.
Did you take care of the fact that we've had seatbelt laws, driving speed limit changes, interstate highway system developed?
Technology. We've adjusted for technology.
How did you adjust for those since they were present in the latter part but not the former part?
We look primarily at a time trend and polynomials of such factors.
Now, you concentrated on fatalities. It may be that inspections because of brakes and tires and so forth might hit the more expensive and the most more likely to be fatal accidents, but the other fender benders and so on might not be decreased at all. Is that possible?
It's possible, but that's not what we found in New Jersey.
You were concentrating on fatalities, were you not?
In New Jersey, we have data on fatalities and accidents.
But as I mentioned, you're using the pre-1938 versus the post-1938, and the driving conditions are entirely different now.
That's right.
The cars have changed, the highways have changed, the speed limits, the seat belts, all the other things. Let me ask another question. Have you looked at any kind of a t-test or chi-square analysis of those states which have inspection versus those that don't? In other words, are the accident rates significantly more in those that have inspection, or less, I should say, than those which don't have inspection?
We've only looked at it in terms of the regression coefficient, the t-test associated with that. We had a dummy variable for states with inspection versus those without.
Mm-hmm. And you took into account the difference in rural versus urban, that type of thing?
Speed, average speed limits on rural interstate highways, hospital access, number of highways in the state.
Is it possible that Mr. O'Neill could also be right when he said that inspection programs may or may not work? They may work in some cases with some good, and some other cases they don't work. He also said there were some studies which took the opposite point of view, that the inspection was an expense, that it was did not justify the results. Would you like to comment on his comment?
Well, I think he said that, I don't think he said that inspection did not work.
He said there were econometric models which said inspection did not do any good. He said there were some like yours which said it did do some good. Would you comment on that, please? Are you aware of the ones that took the opposite?
Yes, I am. I don't know if you want me to mention them, but...
No, I'm not. This is not an examination. I just wondered if you'd comment on his.
Let me speak once again. What I've done is I've examined the models which we've looked at using specification tests. In particular, since you're a statistician, we use Ramsey specification tests, which are highly powerful for detecting omission of variables, misspecification of the structural form, simultaneity equation bias, heteroscedasticity, a bunch of other statistical, technically speaking, gobbledygook. And we found that these models did not suffer from these things, which implies that the estimates which we receive are not biased. In other words, on average, they're accurate. We have no reason to suspect them to be off the mark on average.
Would it be valuable to supplement your study on New Jersey with other states who have changed inspection laws since we've had most of these factors into play?
Very much so.
For example, the western states almost uniformly have eliminated the inspection programs. It'd be interesting to see whether their accident rates increased after they took the inspection programs off or not.
I'd be very interested in doing that. It's also interesting to note that the mountain western states also have a higher fatality rate than New Jersey.
That's correct.
For example, in 1979...
If we have accidents, we have Lulus. I know that. We're like the Audubon Society. I'm Germany.
Could I just interject that over the years there have been a number of attempts to look at the effect of introducing periodic motor vehicle inspection. I know I'm talking in more recent years than 38, and also more recently the effects on accident rates of the removal or the downgrading, if I can describe it that way, of periodic inspection. None of those efforts has been able to show a significant positive benefit for inspection, nor have they shown a significant negative effect of inspection. They just seem to indicate that inspection does not make very much difference. If it makes a difference, it's probably down in the noise.
One other last question, if I may, Mr. Chairman. A later witness, Mr. O'Neill, is going to tell us that the reason the automobile insurance is going up so much is because we have designed our cars to protect on the bumper side. You don't have the unitized body anymore, and therefore the cars we now have protect the occupants better, but they also are much more difficult to repair because of the nature of the cars. Would you like to comment on that? Maybe you could explain why that's so. In other words, we cut down the fatalities, but we increase the cost of repairs. How do we do that?
The modern automobile is basically unibody construction. We have moved away from the old-style frame construction where the car was built around a frame. Unitized bodies permit the manufacturers to design what we call crashworthiness into their vehicles so that they are very good or can be designed to be very good at absorbing the energy of serious collisions so that the forces properly restrained occupants experience are below the levels that produce injuries. So we can do with the unibody a better job of designing energy absorbing capabilities from an injury point of view. The unibody cars that have been in serious accidents tend to be more complicated to repair than an old frame design. You've got to have more complicated equipment in the body shop for alignment and straightening because the body in effect becomes the frame. However, at least for collision coverage losses, the overwhelming bulk of the dollars being paid out and the overwhelming number of the claims are of the minor fender bender variety in the low speed region where this level of vehicle damage is not experienced. And again, it is possible to build a unibody car that has very good crashworthiness, is very capable of absorbing the energy of the higher speed collisions in ways that protect the occupants, and at the same time have effective bumper protection to eliminate the low speed damage. There is no incompatibility between low speed protection and occupant protection.
Gentleman, yield on that point. Are there any formal channels of communication that exist between the automobile manufacturing industry and the insurance industry or the car repair industry to raise and discuss and negotiate the obvious virtues of the point that you just made?
Yes, there are a number of both formal and informal channels. For example, a number of insurers now through their that have engineers on their staff are getting access in some auto manufacturers are giving them access to designs very early on in the process before the design is finalized so that they can address especially some of the cost questions. So this interaction does take place both informally and formally with some auto manufacturers, but not all.
Let me just ask you one last question before concluding this panel. One of your charts that was on before was very impressive in emphasizing the cost of automobile repairs from 1976 to 1986. The cost went up dramatically as contrasted with, well, that's the one. From 76 to 86, that looks like a 200% increase. What is the basic, and I should know this, but you probably know better than I do, what is the basic cost increase of automobiles, of comparable models? I mean, if we talk about small, medium, large, I mean, I can recall buying a brand new automobile for $1,500 in well, a long time ago. Are the repair costs tracking the product costs? We all know that they've gone up and they're very expensive now. I've been out to a local community college where young students are being trained to be automobile repair people, and they're into computers. They're learning a lot of very sophisticated things, because to repair the car, you've now got to be a computer technician rather than just somebody that beats on a fender with a rubber hammer. So all of those factors make understandable the repair cost, but I'm interested in knowing whether the repair cost increase in any way roughly is correlated or tracks the overall costs of automobiles.
That repair cost increase is actually almost a factor of 3, because we put that on an index basis, so it's gone from 100 all the way to close to 300. So it's a 3-fold increase in 10 years. Automobile prices for the same types of cars have increased over that 10-year period, but they've not increased 3-fold.
Is it not also the case that the universe of automobiles, particularly top-end luxury sports models, seems to me, a much larger proportion of the universe of automobiles that are out there now than they were 10 years ago?
There's no question, especially in the last few years, there's been a big growth in the luxury or semi-luxury new car market, and that does have an impact on the total cost of car purchase. I don't have in my head indices that would say what was the average cost of a car in '76 versus the average cost in '86, but I'd be happy to get that information and put it in the record.
Interesting. Let me express the appreciation of the committee to our panelists and say thank you very much. We appreciate your participation. We now will move to our next panel, which is made up of Lieutenant Robert Morgan of the Auto Crime Division, New York City Police Department, and Mr. Frederick Kripe, an actuary for Allstate Insurance Company. Lieutenant Morgan, Mr. Kripe, we welcome you to our committee. I want to apologize to everyone in the attendance for the warmth of the room, but I decided to give you some sense of the heat that political people are currently experiencing in dealing with automobile insurance rates in their districts. And we thought this was the best way we could come close to emulating it. Lieutenant Morgan, please feel free to proceed.
Thank you very much. Chairman Florio, members of the committee, Police Commissioner Ward is most enthused about your subcommittee's work and hopes the following information is helpful to you. Auto losses nationwide are running at the alarming rate of about 1.2 million per year. The 5 boroughs of New York account for approximately 8% of the nationwide figure. The theft rate for the 5 boroughs of New York City for the last 4 years are as follows: 1984, 88,478. 1985, 79,426. 1986, 85,662. 1987, 94,528. There is no crime which produces as such a large percentage of profit with such a corresponding low risk of apprehension as auto larceny. A typical chop-chop operation is run at a 1,000% plus profit margin. Autos are in abundance in New York City, enabling the adept thief to shop around till he finds the auto he wants parked in a location which will allow him enough time to ply his talents. The money he will make will be clear profit. Since the automobile has become a necessity, the market for car parts is enormous. Automobile theft offers the availability of product, high profits with a minimal risk, and a ready market for the product. Auto thieves fall into 4 general categories. The parts thief. The New York City Police Department estimates that vehicle theft for parts accounts for approximately 55% of all vehicles stolen. The parts thief is a major menace. He can steal and strip a car into its components parts in a matter of minutes. The reason he is so successful is because he provides parts for salvage yards and body shops faster and cheaper than the manufacturers can. If a shop needs a particular part of a car, the owner has two options. He could order through legitimate channels, wait for delivery, and pay top dollar. On the other hand, the parts thief can provide the same piece and deliver it overnight at a far cheaper price. An additional bonus is that it will usually be assembled and factory painted to fit the car to be repaired. This type of thief is difficult to apprehend, and vehicles stolen by him are generally not recovered. The chop shop is the primary source of supply for stolen parts. Organized crime is heavily involved in chop shop operations. A chop shop is basically an illegal vehicle dismantler with a highly organized staff. A typical chop shop operation functions with little or no overhead at a 1,000% plus profit margin. Insurance fraud. Organized crime has discovered insurance fraud as a lucrative source of income. In their constant search for new ways to make money, organized crime has recognized the potential for profit in insurance fraud and has devised numerous schemes to defraud the insurance companies of our money. Organized crime is not alone in trying to defraud insurance companies. As the cost of the individual car escalates, the car owner has come to realize the profits to be made by making his vehicle disappear and report it stolen. Persons involved in this scheme run the spectrum from blue-collar workers to company presidents. Insurance fraud is not the victimless crime people often perceive it to be. Profits from this type of crime run into the hundreds of millions of dollars annually, causing astronomical increases in insurance rates. We are all victims of this crime through the assessment of higher insurance rates. Insurance fraud is one of the least recognized and most misunderstood of crimes. This category accounts for 25% of the total reported vehicle thefts. The professional. The professional is an expert in the altering of vehicles to disguise their true identity. The pro can steal, alter, re-register, and sell a stolen vehicle with such proficiency that in many cases his finished product will find their way into the hands of innocent buyers. His contacts in organized crime make it easy for him to secure the necessary forged, stolen, or salvaged documentation needed to register the stolen vehicles. It is not unusual for vehicles altered in this way to remain undetected until recovered by specially trained police officers. In many instances, the altered and resold vehicle are never detected, but the rate of recovery of these vehicles is increasing as the necessary specialized training is being made available to all police officers. This category accounts for 15% of the total reported vehicle thefts. The joyrider. This is usually the youngster who steals a car to take it for a spin, or the criminal who needs a getaway car. Fortunately, cars stolen by this type of thief have a high recovery rate. They're usually recovered without any parts removed and out of gas. This category accounts for 5% of the total reported vehicle thefts. The New York City Police Department supports your committee and its work and stands ready to assist you in your endeavors.
Thank you very much. Mr. Kripe?
In the interest of time, I have a very brief statement to read, and then we'll be happy to answer any questions you might have. I'll talk a little bit about the effect of auto theft on insurance premiums. Essentially, there are two kinds of auto insurance that covers damage to an insured's vehicle. Collision insurance covers the car for the collision perils, running into another vehicle, into a fixed object. Then comprehensive coverage covers the vehicle for other types of damage, such as vandalism, wind and hail, and auto theft. In 1987, over 45% of our comprehensive coverage losses, that's the non-collision type losses, were due to auto theft for Allstate Insurance Company. That amounts to approximately $40 per policyholder per car for those insuring their cars for comprehensive coverage, which may not seem like much, but that amounts to roughly $400 million for all Allstate policyholders countrywide. In total, the auto theft produced $7 billion in losses for the American people. If auto theft were a business, it would rank 59th in the Fortune 500, right ahead of Union Carbide. Auto theft has a significant impact on comprehensive premiums in individual states. Of the 10 states with the highest 1986 theft rate per 100,000 vehicles, 8 of them were included in the 10 states with the highest average comprehensive premiums for our company. The theft peril also varies significantly within the state. According to the National Auto Theft Bureau, Chicago and the surrounding communities produce 87% of the total auto thefts in Illinois. That's reflected in the comprehensive premiums. The comprehensive premium in Chicago is roughly 4 times the comprehensive premium in Springfield, Illinois. Theft potential also varies significantly by the automobile and has a significant impact on the comprehensive premiums for those autos. Once again, of the 10 autos with the highest theft rate per 1,000 cars manufactured, 6 had rates increased under Allstate's Make Model Experience Rating Program, and 2 vehicles in that 10 would also have had their rates increased had it not been for significantly better collision loss experience. In summary, between 4 and 5 cents out of every insurance dollar that's paid to Allstate is a result directly of auto theft. Thank you.
Thank you very much. Lieutenant Morgan, and perhaps Mr. Kripe as well, I'm a bit confused because I don't understand what the economic incentive is for the body shop owner to take the chance of using stolen parts, presuming that he knows they're stolen parts or has suspicions. Because isn't he reimbursed by the insurance company for the cost? I mean, it's a sort of perverse outcome, but if he pays $10 for something legitimately, he will get, presumably, the $10 back. On the other hand, if he pays $5, unless he's going to mark up the $5 to be a $10 part, he's going to get $5 back. What am I missing?
First of all, the parts, usually the body shops put on the car, aren't identifiable. There are no markings on these parts. When they take the parts off the stolen car, they bring them to usually a salvage yard. The auto body repair place goes to the salvage yard to buy used parts. They're given money by the insurance company to repair the car. Now, you said if they're given $10 for the part, well, if they can be given $10 for the part by the insurance company and they only have to pay $5 to the salvage yard, they have a $5 profit right there.
So then really the burden shifts back to the insurance company in what one would normally think as an oversight responsibility to set appropriate prices for parts so as to be able to ensure that the parts that are being obtained at reasonable costs. I mean, obviously we want some competition out there among legitimate suppliers, but I would think when someone comes up to the back door with a van full of parts that are priced extraordinarily below what the market would bear because they had no overhead in obtaining the price of the products and the parts because they stole them, I would think that would be a fairly obvious connection that somebody can make. Again, I feel like I'm either naively missing something or I'm just not having things explained to me.
Well, I guess the answer to that question is that if, in fact, the insurance companies said, well, we'll pay new market prices for parts, period, then you would simply find thieves stealing automobiles and selling the used parts at new or just below new parts prices. In other words, the economic incentive is still there to steal and to sell those parts back. What price you can get basically depends on the availability of those, quote, stolen and the true salvage parts.
I guess what you're saying then is that there's no ability to make a distinction. Forget the new parts replacement. That presumably is fairly standardized. But if we're talking about used part replacement costs, the difference between the junkyard that is in the commercial business of obtaining parts that has to pay presumably for some of those parts, and the other operation, the chop shop operation, that has to pay not a whole lot, there's no distinction there?
In fact, in most cases, the stolen parts are run through a legitimate-looking junkyard operation.
Well, let me say this about the replacement of parts on a car. Let's say you have a 1988 car and you get into a collision and your front end, we call it the front clip, is damaged. Now, if you go to a legitimate repair shop will say, fine, I will order you this part, this front clip, okay? A new front clip from General Motors. Unfortunately, they're low in stock on them, and it'll take at least 3 months for the part to get here. On the other hand, he can go to a salvage yard, get a part in the salvage yard that has recently been stolen off a similar model car, that's already painted the same color as your car, and he can get it overnight and have it installed on your car within a week. All right? Now he will get he will have the insurance company will pay him for a new part. Now you're satisfied because you don't have to wait the 3 months to get your car back on the road. The insurance company's paid for the part, they've paid for the new part, and you're just as happy with this. This is actually a new part as far as you're concerned.
Is there anything that the automobile industry or the insurance industry can be doing to reduce the prospect of that scenario that you just described playing out?
Yes, there's a law on the books right now. It's called the Motor Vehicle Theft Law Enforcement Act of 1984, which requires the marking of all major component parts. The New York City Police Department welcomes this legislation to deter vehicle theft and provide identification of the major component parts. We have successfully used these Mylar labels on the vehicles to arrest people for possession of stolen property. We would recommend that, in addition to this to help this legislation along, that these Mylar labels, number one, be placed on not just the high theft line model cars, but on all cars. And number two, we would recommend that it not just be restricted to those major component parts, the 14 major component parts, but other high saleable, unidentifiable parts such as T-tops, radios, and computers. A third recommendation we would like to make, that perhaps it's a bit of a pie in the sky because we realize the economic realities are that it's very, very expensive. We would like to have these parts marked not just with a Mylar tape, but have the numbers actually stamped into the metal or etched onto the metal. This way, if the thief comes along and removes it and replaces it with another number, we can recover that number with acid restoration.
Does anybody actually do any of this? I mean, it sounds nice.
Yes, we do.
Is it resulting in anything?
At this time, on the New York state, part of our problem with the motor vehicle theft law is the definition of terms. In the New York State penal law, the definition of a VIN says one thing. The motor vehicle theft law of 1984 calls for the Mylar labels. In New York State, the Mylar labels are not identified as a true VIN number. We have legislation in Albany at this point in time to change the definition of a VIN number to include the Mylar labels. We expect that this legislation will be enacted into law sometime in September of this year.
Mr. Kripe, when rates are set in this area, do we set rates on the basis of the probability or the possibility of a car that one is trying to insure being that type of car which is most probable to be stolen for purpose of parts?
Essentially, yes. Allstate has what we refer to as the Make Model Experience Rating Program, which looks at the physical damage loss experience, both collision and comprehensive, of automobiles. And then based on that loss experience, either adjusts the rate upwards or downwards based on whether or not that vehicle in total has poor or better physical damage loss experience. So, for example, a car that was stolen more frequently would tend to have poorer physical damage loss experience and would in fact receive higher rates.
I don't know if you're familiar with New Jersey, but New Jersey, we have the ISO system wherein right now the commissioner is entertaining a 14% increase in automobile insurance rates. The comprehensive and collision, does that get rolled into that 14% across the board increase?
I'm sure it's part of the measurement of that 14% rate increase. Yeah. And in fact, ISO has a program similar to, but not identical to, Allstate's vehicle series rating, in which they also adjust vehicles for their loss experience.
I guess I have a difficult time then trying to understand the degree of capability of modeling rates in accordance with all the variables that you and the previous panel talked about in light of the general rate submissions and across-the-board increases that are approved, disapproved, or modified. How is it that you say that we're factoring in these variable specific modifications when the system is a general rate increase?
Well, because the modifications that we discuss are relative to the overall average, all right? For example, our make model experience rating program generally produces either a very small decrease or no change in premium overall on a countrywide basis. In other words, the number of models that are increased relative to the average, the premium for that exactly equals that of the models that's decreased. So in effect, when you're looking at an overall rate change, that includes not the effect of increases in premiums. In other words, we don't just go out and say we're going to increase these people's premiums above where they are today and these people we're going to leave alone. We say we're going to increase these people above the average, these people below the average, and then for overall rate needs, as determined by the actual increasing costs of parts, medical payments, etc., we'd have what we call overall rate level increases.
So the charts that we were looking at before, that if you've got someone who lives in the rural area with the safer big car that is not a preferred car for stealing, though all of those variables are factored in at one point, the ultimate average for the rate increase is of no benefit to that person by virtue of those types of factors that would be of less detriment to the insurance policy of the insurance industry.
In fact, they do benefit from it because they receive lower rates than they would otherwise get had not those things happened. For example, everybody will have lower rates by virtue of having that proportion of people with those lesser risk variables. Is that what you're telling me? No, those people who have the lower risk variables will receive lower rates than the average, I guess is what I'm saying.
Okay.
In other words, we start, if you will, with an average rate and then move our rates about that average based on, in this case for vehicles, the loss experience of those specific vehicles.
Let me just, at this point, and we'll probably get into this a bit more with some of the other panelists, but since we're talking about theft and fraud, I would, without objection, put into the record the article that appeared today in the Washington Post on page 1 that states that undercover investigators posing as motorists were charged thousands of dollars for work not done, according to law enforcement officials in the Maryland Attorney General's article office. The article is labeled "Seal Case Hid Suspect Auto Repairs." It's just an interesting aspect of sort of alleged fraud that may very well be taking place in this problem area as well. Let me express the committee's appreciation to our two witnesses, and thank you very much for your participation. Ingham?
Just elected the general counsel on Monday.
We are now pleased to have Mr. C.A. Pete Ingham, Associate General Counsel of State Farm Insurance Company, and Mr. Howard Irving, Director of Property Claims of Prudential Property and Casualty Company. It's my understanding that, Mr. Ingham, you've just been elected General Counsel of State Farm Insurance Company. We offer you our congratulations and best wishes.
Yes, thank you.
That position, which we assume is a promotion.
And I hope it sticks, yes.
As I previously stated, statements by the witnesses will be put into the record in their entirety, and the witnesses may feel free to proceed in a summary fashion if they see fit.
Mr. Chairman, members of the subcommittee, I am Pete Ingham, General Counsel of State Farm Insurance Companies. We appreciate the opportunity to appear here before you today to outline State Farm's rate-making process and claim procedures for insurance coverage, damage to automobiles, and to describe our efforts to contain and reduce the cost of providing auto insurance. Although the amounts paid out by insurers for bodily injury claims have received considerable attention, there has been, before today, little examination of the auto claims dollar. 60% of that dollar pays for damage to property. The size of this figure gives us a large, substantial incentive to try to contain the cost of property insurance, and we're pleased that these hearings will bring the situation of this important component of the claims equation. State Farm is the nation's largest auto insurer. We insure approximately 29 million automobiles. Last year, in 1987, we paid approximately 6.7 million auto property claims, valued at about $4.6 billion. So we have a great interest in keeping down the cost of repair and the auto insurance rates. At State Farm, we develop our auto insurance rates totally independent of all other insurers, and we are not a member of a rating bureau. I'd like to take a few minutes to explain our basic process for determining rates. Any insurance rate reflects two basic components. First, the portion necessary to cover claim payments. Secondly, the portion needed to cover our expenses, including a reasonable allowance for profit and contingencies. This allowance takes into account consideration of our income from all sources, including investment income. The claims payment portion for damage to property counts between 70 and 75% of the auto property insurance premium. And this is computed by taking the two types of data pertaining to losses into account. First, the average cost per claim, and secondly, the frequency of claim. Now, there are, of course, unforeseen changes in the economic climate after we've determined a rate level. For example, there might be a drastic change in the inflation rate, unanticipated changes in the driving environment, for example, the changes in the speed limit, changes in the legal drinking age, which might require us to adjust our figures from time to time to meet our financial needs. If this occurs, we apply to the state regulatory authorities for a prospective rate change, but it bears some emphasis that we never attempt to recoup past losses through future rate changes. Conversely, when we have found in particular states that the rates we initially determined were necessary to meet our financial needs turned out to be more than we needed, we have paid our policyholders a dividend. Last year, in 1987, we returned approximately $200 million to our auto policyholders in the form of dividends. State Farm, like many other insurers, we have rate classifications. Our basic process for determining rates is expanded to take into account variations in risk that have been substantiated by our historical experience. In this way, our rates are tailored to reflect the individual characteristics of our policyholders. Our experience has shown that claim costs may vary by geographical location as well as with the value and characteristics of the car. Claim frequencies, too, will vary by geographical location and depending upon how the vehicle is used, who the drivers are, and the characteristics of the car. We take these risk factors into account by varying the rates on the basis of objectively determined groupings or rate classifications. Going to the Chairman's earlier questions about make and model rating, we at State Farm have make and model rating. Stated simplistically, the way it would work, we would have a single rate for all vehicles that cost new, let's say, $12,000 in 1988. Then, according to the experience for that make and model, the rates can vary up or down. They can go down as much as 45%, up as much as 75%, according to the experience for that particular make and model. Speaking briefly about State Farm's claim handling system, State Farm has long been committed to handling policyholders' claims in a way that is efficient and as fair as possible, and hopefully as painlessly as possible for the policyholders. One methodology, many of our policyholders' smaller claims, usually under $1,000, are settled by one of our 17,000 agents. In 1987, our agents paid more than 1.8 million claims under this Agents Draft Authority program. This was nearly a quarter of all the auto insurance claims State Farm paid last year. We have another program for auto glass claims. For claims for damaged auto glass, the State Farm agent will arrange replacement by a mobile glass service at any location convenient to the policyholder, their home, where they work, or another location. During 1987, State Farm agents handled 1.1 million auto glass claims in addition to the 1.8 million claims they handled pursuant to the Draft Authority program. These glass claims totaled approximately $200 million in value. Our second method of handling claims is through service centers. We have 18,000 employees involved in the handling and settling of claims in addition to our agents. These personnel handle claims that are beyond our agents' draft authority, often at one of State Farm's service centers. We have a nationwide network of service centers and locations that are readily accessible to our policyholders. We have found our policyholders overwhelmingly satisfied with this quick and convenient service, and we have approximately 700 service centers in the United States. The cornerstone of State Farm's approach to settling auto damage claims, which we advertise to the public, are twofold. First, the owner of the damaged vehicle always has complete freedom of choice as to where the vehicle is repaired. The owner chooses the body shop. Secondly, our payments for repairs will be based upon the prevailing competitive prices for such repairs in the market. We believe our appraisal system is expeditious and rigorous. State Farm's auto body damagers appraisers examine the vehicle, prepared a detailed appraisal of the damage, including a list of all damaged parts, a determination as to whether the part is to be repaired or replaced, estimate of labor hours, refinishing hours, and the materials required. It is through our claim settling process that we collect the raw data for our rate-making process in the future. And from those data, we learn, for example, that of each and every dollar we pay to policyholders for vehicles repaired as a result of a collision, about 60% pays for the replacement parts and approximately 40% pays for repair costs. Those are where we actually pay to repair a vehicle. As a side note, it should be noted that in the claim process of all our claim dollars for vehicle damage, approximately 25% of the dollars are spent for total losses, which means that vehicles are not repaired. That is a number that has been growing in recent years as vehicles get smaller and more fragile. The rates we charge insurance consumers are a direct outgrowth of these costs and others, such as those inherent in car designs that make automobiles easier to damage and more costly to repair. Clearly, the more effectively we can contain the costs that affect insurance pricing, the better we can control the prices we charge our policyholders. Looking at some of the ways we've dealt with cost containment, we've been involved a number of years on a wide range of fronts to contain and reduce insurance costs. For example, one major component of the cost of providing insurance is the cost of crash parts, such as bumpers and fenders. For years, the auto manufacturers had a virtual monopoly on both the manufacture and distribution of these parts. However, in the early 1980s, competition began to emerge. New manufacturers of crash parts arrived on the scene to compete with car manufacturers, and their distributors began offering competitive crash parts at a fraction of the price charged by the auto manufacturers. State Farm has watched these trends, charted the prices of crash parts for the last several years. We have seen, since the emergence of competition, dramatic decreases in the auto manufacturers' prices for replacement parts for which competition has developed. For example, the price of a 1981 Aries fender fell from $221 in 1983 to $87 in 1986. A competitive product was available in 1986 for $65. The price of a 1983 Omni fender fell from $140 to $76 during the same time period. The competitive product was available in 1986 for $65. By contrast, for parts where there is no competition, the prices remain stagnant or increased. The 1982-84 Cavalier fender, for example, cost $151 in 1983, $163 in 1985, and $150 in 1986. It is clear to us that competitive crash parts have been a significant force in controlling our cost. So far, competition in these parts have produced savings to the State Farm policyholder group of approximately $30 million. Unfortunately, our policyholders have not enjoyed the full benefits of these savings because auto manufacturers have recouped approximately $15 million of these savings by raising their prices on those parts where there is no competition. Obviously, this net reduction in profits that the auto manufacturers have had to absorb has not made them too happy. They have banded together to push various legislative and court solutions. State Farm, others in the industry have resisted their efforts. For example, we are continuing to urge the defeat of federal legislation, Senate Bill 791, House Representatives 379, that would allow auto manufacturers to copyright their fenders and other crash parts. We oppose the auto manufacturers' efforts to secure state legislation that would restrict the use of competitive crash parts. We believe these attempts through legislation and litigation artificially to eliminate competition are contrary to the public interest. The desirability of competitive parts is an issue for consumers to decide, and we are prepared to do what is necessary to preserve that freedom of choice for the consumers. And just recently, we have joined with other insurers, body shops, consumer groups, parts distributors to form a nonprofit organization, Certified Automotive Parts, CAPA, to establish quality standards for competitive crash parts and to test and certify such parts. This will give consumers, body shops, insurers knowledge of quality parts that are equal to original equipment when they are purchasing parts in the marketplace. State Farm is a longtime advocate of improved damage resistance features in automobiles. Shorthand, better bumpers. For some 20 years, we have urged adoption of standards requiring bumpers that can sustain an impact of 5 miles per hour. We actively supported Congress' adoption in 1972 of the Motor Vehicle Cost Savings Act and promulgation of the 5-mile-per-hour standard under the law. In 1982, however, the National Highway Transportation Safety Administration rolled back the standard to 2.5 miles. We and others brought suit to challenge the erroneous methods and assumptions upon which the agency based this action. Unfortunately, the court ruled against us in that suit, and our efforts and the efforts of others have given the issue public visibility. And once the public became aware of the issue, it was not long before the auto manufacturers began voluntarily strengthening their bumpers. Some of these new bumpers are in fact markedly more damage resistant. Others are still shockingly deficient, as Mr. O'Neill's testimony indicated. We continue to press for meaningful standards in this area and for fuller disclosure to the consumers. State Farm was an active supporter of Motor Vehicle Theft and Prevention Act of 1984, which was talked about by the previous speakers. The legislation required the marking of certain parts of high theft automobiles and increased federal penalties. Basically, they require the marking of the VIN number on new automobile parts, the 14 most commonly damaged, and for commonly damaged vehicles. That just took effect in 1987 model vehicles, so we have not yet had a real opportunity to ascertain the results as far as the theft rate for those particular automobiles that are out on the street. In other areas, we've worked with the auto manufacturers to encourage them to design cars that are more damage and theft resistant and easier and less costly to repair. And I believe an additional incentive there is the make and model rating done by State Farm and other insurers. State Farm is part of the National Auto Theft Bureau, which gathers statistics, information, investigates auto theft rings. ICAR, an industry, insurance industry, auto body education group concerning auto body repairs. The Insurance Crime Prevention Institute to deal with fraud, and of course the Insurance Institute for Highway Safety, and Mr. O'Brien spoke for them today. If I could conclude by thinking of the chairman's opening remarks and some of the heat that is being generated. Typically, when heat is being generated in the insurance area, there are basic complaints that might emerge towards somebody. One is not enough of the dollar goes in claim payments. Secondly, the rates continue to increase. And thirdly, there's friction in the system between the consumer and perhaps the insurer. Going to the question of not enough of the claim dollar goes in actual claim payments, for our motor vehicle part of our premium, 75% of that goes in the form of claim payments, which we think is a high percentage when compared with the bodily injury side of the equation, which is closer to 65%. Secondly, as far as rates continuing to increase, at State Farm, our comprehensive rates, which are basically for theft and auto glass, countrywide have declined the last 5 years in a row. Our collision rates have declined 3 of the last 5 years countrywide. So we think there has been a leveling and improvement in the experience as far as motor vehicle damage is concerned. We believe that insurers are competing vigorously, hundreds of them, for the auto insurance business. There are thousands of auto body shops competing vigorously to repair automobiles. We are beginning to see some competition in the crash parts area, which is a marvelous cost containment feature. We believe that the efforts of all parties accepting their responsibility have produced insurance rates that by and large are fair, competitive, and in most areas affordable. We think the motor vehicle damage of the equation, we are making real progress.
Thank you very much. Mr. Irving.
Good morning. Thank you, Mr. Chairman. We appreciate the opportunity to be here today and express our views on a number of these auto repair issues. I'm Howard Irving, Director of Property Claims for the Prudential Property and Casualty Insurance Company, or as we refer to ourselves, PRUPAC. With me today is Dave Farmer, Vice President of the Alliance of American Insurers. We've already provided you and the members of the committee with a written statement, so I thought I might just take a few minutes to discuss some of the highlights of that and go into a little more detail about the claim handling process that we utilize, and then try to answer any questions that you might have. I want to start first with service, which is one of the two things that any policyholder is concerned about. They want their claim serviced quickly, and the other, of course, is they want to be paid the proper amount. We make outstanding claim service our goal, and I'm very pleased to report to you that PRUPAC was rated number 2 in the state of New Jersey in an insurance department complaint survey that was just released last week, which certainly was very gratifying to us. We spend a great deal of time and money on training and educating our claim personnel. We have about 2,000 claim employees in the company. Last year, over 700 of them came to our home office for various types of training ranging from 1 to 3 weeks in duration. And the types of programs range from a claim trainee course for adjusters first starting in the business to field adjuster advanced training classes, various types of claim supervisory courses. We also have a professional development plan where we encourage all of our claim employees to help further develop themselves through various types of study programs, such as the CPCU designation, IIA courses, college tuition refund programs, things of that nature. We employ the latest computer technology. Our claim system is an extremely advanced one. We have the ability, excuse me, we have the ability to take a telephone call from a customer, immediately access their policy file, confirm coverage, set up the claim, and institute the process immediately. This is not only a way of providing better service, but it cuts out clerical expenses, which are, of course, a benefit in the rating process. I thought I'd talk a little bit about the training that we give our auto appraisers, who are the people out on the street dealing with the claims that we're discussing here today. We hire experienced adjusters who have body shop backgrounds, as well as trainee adjusters coming out of college. So I thought I'd talk about the training program for the typical college trainee. We have a 6-month program that we utilize that starts with basic insurance coverage training, information about how to deal with policyholders, information about automobiles, the way cars are constructed. Weeks are spent in body shops observing repair techniques. We then send our adjusters to a 2-week school where they get extensive training in the repair and estimating process. Upon return to the claim office from that school, they're closely supervised by a supervisor for several additional months. We don't allow them to handle claims for a period of time until the supervisor has spent enough training with them to feel comfortable. We try to give them small losses initially under close supervision, typically at one of our drive-in claim centers where a supervisor is present to assist them on an ongoing basis. We then, at about the 6 to 12-month mark, bring them to our home office for a 6-day training course, which we refer to as advanced auto adjuster training. We give them several days of training at a vocational school using an ICAR instructor. That's the Industry Conference Auto Repair Organization. We demonstrate the latest techniques using unibody construction and repairs, things such as plastic repairs, 2-stage paint, the laser measurement process, and so forth. We closely supervise our adjusters. Our field adjusters typically work at a ratio of 3 or 4 adjusters to 1 field supervisor. We also have a staff of corporate, we call them re-inspectors, that periodically go around the country and spot check the work of both our supervisory and claim adjusting personnel. We have quality control requirements built into our claim handling process at all levels. Our supervisors and managers are required monthly to conduct a random sample of work performed by all of our claim employees. Dealing specifically with auto repairs, our field supervisors have to re-inspect a certain number of vehicles that have been appraised by our field adjusters. They have to contact the vehicle owner, make certain that the adjuster followed all of the company procedures in handling the claim, including explaining the loss settlement to the consumer, providing them with a copy of the estimate, making sure that the amount paid is proper. Our PRUPAC adjusters are also required to take the ICAR training courses. I believe there are currently 9, but I'm not positive of the number. But these are designed to keep our adjusters abreast of the latest repair technology in the industry, particularly with the unibody construction vehicles. A very high percentage of our field adjusters and our supervisors have successfully completed the entire series of courses. And I might add that a lot of this is done on evenings or on weekends, and it reflects a personal commitment on the part of our claims personnel. We utilize drive-in claim centers throughout the country where it's possible for a policyholder or a claimant to call us, make an appointment at their convenience to bring the car into a location that's close to them. We find that, as State Farm mentioned, that this is an excellent customer relations tool, and I would add that it also helps hold down the costs of auto insurance because we are more efficient in terms of the productivity that an adjuster can accomplish in one day. If all of the cars drive to him, he can handle more claims that day than if he has to drive out and to inspect them. Therefore, we can hold our expenses down somewhat. We use staff adjusters on approximately 97 or 98% of all the automobile repair claims that we inspect. We use very few independent adjusters. We found that our staff adjusters do a better job in controlling lost payments. We also utilize telephone claim handling techniques where warranted on small claims that do not involve coverage questions or where there's a need to do any type of investigation. Glass claims, towing claims, or perhaps a policyholder who's been with us a number of years and never had a claim might live in a remote area where we don't have an adjuster. They have a $500 bill for hitting a tree as they back out of the garage and a $250 deductible. That's the type of claim we would handle by telephone. It's cheaper and more efficient to do that, and again, that helps hold down the costs. We employ computerized collision estimating. We have about 325 auto adjusters with computerized estimating kits. This gives them the ability to produce an estimate on the spot. It's extremely fast. It's more accurate than doing an estimate manually. It eliminates human error. All of our adjusters carry drafts, and we're able to conclude and pay a claim on the spot and issue the vehicle owner a copy of the estimate, which is in printed form and very easy to read. We conduct claim audits of all of our claim offices on a regular basis. These are conducted by myself and members of my staff to ensure that proper claim handling standards are in place. We look at every aspect of the automobile claims handling business. I just highlight two or three things that we go into detail on. One is the salvage returns that we get from total loss vehicles. We look very closely at the rates of returns we get from different facilities to try to maximize the return. We also look very closely at the storage, excuse me, at the storage charges. The storage charges are those fees that a tow shop would charge. Some of them could be $20 a day while the car is sitting there waiting to be picked up, taken to a salvage facility. I happened to meet with a salvor in New Jersey just last week who represents 8 or 9 insurance companies in the state, and he mentioned that our salvage charges, our storage charges, I should say, are about half what the industry average is, which we're very proud of. We also focus a great deal of attention on our subrogation recoveries, which simply means if an insured has, say, a collision claim that's caused by another driver, if we pay the collision claim, we would in turn seek reimbursement from the other driver, and we have a very successful record in that area as well. And again, reducing salvage, I should say reducing storage charges, increasing subrogation recoveries, and increasing our salvage returns all help keep down the costs of the insurance product. We've also been very active in the anti-fraud area. All of our claims personnel are thoroughly trained to detect and investigate suspicious claims. We also have a staff of investigators who specialize in handling large dollar suspicious losses or where there's an indication of an organized ring involved. We fully cooperate with law enforcement officials and other agencies in the investigation of fraud, and we have a company policy of pursuing prosecution where we feel appropriate. We've recently begun the use of competitive replacement parts in order to further help reduce insurance costs. There's been other testimony today on that point. I just would mention that we fully support CAPA, which is the Competitive Auto Parts Association, which has been organized to certify these competitive parts equal or better than OEM in fit and quality, and we have funded that organization to help in that effort. We certainly would caution about any further regulations curbing the use of competitive replacement parts. The testimony earlier today about the significant reductions in the OEM crash parts prices is certainly something that deserves a great deal of attention and shows the impact of the competitive replacement part industry. That concludes the remarks that I have today. I've tried to describe the types of actions that we employ in our day-to-day handling of claims to help keep the costs down, and other insurance companies have very similar programs or additional programs that they have designed on their own to accomplish the same end. We'd be happy to try and answer any questions.
Thank you very much. Let me just express my appreciation to both of the witnesses for their detailed presentations. I guess the part that I'm just a little struck by was after both witnesses detailing all of the good things that you're doing in terms of efficiency in your claims process, in terms of the dramatic and impressive results from the parts competition, the competitive parts results that you've experienced. I'm not sure, unless there's something particularly unique about your two companies, how does that square with not only the charts that the previous speaker talked about in terms of the dramatic increases in costs in light of some of the points that you've raised, as well as, quite frankly, the common sense perception that costs are not being controlled even, much less being reduced on the basis of the types of things that you've pointed out to us that you are experiencing, which I thought, Mr. Ingram, you indicated that is resulting in reduced collision costs for your company. Can you square some of that?
Yes, Mr. Chairman, let me clarify. I think you're referring to my comment about the rates for comprehensive coverage have declined for 5 years and the collision coverage 3 out of the last 5. Those are the rates. Now, the individual policyholder, if he buys a new car, would not notice the decline because that rate is applied to a higher price. Because the price of vehicles are higher than they used to be.
So it's a rate off of the cost of the car?
Yes, that is correct. So some of them would not see the decline, particularly those buying the newer automobiles that have gone up in value by quite a bit.
But let's assume someone has had the same car for the past 5 years. You're telling me that they would have experienced a rate decline?
Very possibly, and it could.
One of my constituents.
It would vary by automobile, depending upon what that automobile is worth today, because the pricing starts with the value of the automobile as far as collision comprehensive are concerned, and then you apply the factors for make and model.
I mean, there aren't too many automobiles that appreciate in value as time goes by, so other things being equal, if the rates are declining, a 5-year period, the rates are declining even if it stayed constant in value, which is probably not the case. It usually deteriorates in value. It would seem to me that that representation would result in many more people experiencing rate declines, and I haven't run into any of them.
You have the phenomena that if newer cars are worth quite a bit more, then the 5-year-old cars are worth more than they used to be. They kind of track along together is part of it. But there are two parts to the rating equation. One is the cost of claims, and the other is the frequency. And during some of that time period, in the last 5 years, we've seen a decline in the frequency of our claims involving property.
It's interesting because the other chart did not reflect that. The chart that was shown to us indicated relative stability in frequency and there was one other variable that was relatively equal as well. It was
Yes.
only the cost payout that was a dramatically increased one, which I would think would be a factor of rate. And if you're telling me the rates have gone down, I'm not sure how all of those things square.
In our experience, we have had
Okay.
those declines in our
Something that you
rates.
think you're doing that's unique, that doesn't reflect the rest of the auto insurance industry?
I think the others must be close because they compete with us in price. And of course, the other factor is when you're in the rate-making process, after you figure out what you need, then you make the competitive judgments, which invariably are downward.
If I recall, in New Jersey, your company is not part of the ISO system, is
That
that?
is correct. We are not part of the ISO system anywhere.
And ironically enough, if I recall, and correct me if I'm wrong, notwithstanding not being part of the joint submission rate, your rates are higher than the ISO rate. Is that incorrect?
I don't believe so.
Okay, well, I stand corrected.
We've had a rate filing pending in New Jersey since 1983, which is an increase, and we have suffered tremendous losses in New Jersey. We are not an ISO. We would like to have our rates at a much higher level than they are. We're losing money in New Jersey.
Higher than the ISO?
Yes.
Well, I mean, that was my point. I guess I would have assumed that if someone is outside of being rolled into joint submissions where in that combination you have efficient and less efficient operations, if one purports to be an efficient operation, if one has some interest in capturing market share, one is going to try to underprice the joint submission of numbers of companies of mixed effectiveness and efficiency.
We have no real interest in capturing market share in the voluntary market in New Jersey. We would like to have our rates much higher. In the regulatory machinations back in time, there were a number of independent filers who gradually became a part of ISO because ISO's rates would be considered first by the regulator. And then the later movement, if any, was from the independent filers. I believe we're about the last independent filer left.
I guess I'm a little troubled or maybe even startled by the assertion that you have no interest in capturing market share in the voluntary market. Why would that be? I mean, that's not normally our competitive mode thinking. If one can capture market share, theoretically, that's a desirable competitive practice.
Well, stated rather simply, last year, 1987, we had a 9% underwriting loss in New Jersey. We've had underwriting losses 10 years I can remember. The rates for all auto insurers have been artificially repressed. I see no one trying to increase their voluntary market share. Some of the insurers, auto insurers, that's the only market they operate in, and they have our sympathy.
So in a sense, what you're saying is that notwithstanding the perception that automobile drivers have that they are being charged an oppressive amount for automobile insurance, the rates aren't sufficiently high for you, a legitimate business in this field, to want to go out and take on customers.
That is correct.
Well, I will tell you, you will have a hard time trying to make that sell to most people. I mean, well, I will just leave it at that for this point. It is a very difficult thing to try to convince everybody in the state that they're not paying enough, and to have someone assert that rates have to go up in order to get competent, legitimate people to play by the normal rules of the marketplace, which is you want to be gaining more market share so as to maximize some benefits.
Yes, and I understand the concern of you and the folks in New Jersey, and that they have the highest auto insurance rates in the nation.
And the commissioner who was here not too long ago indicated to us that the automobile insurance industry in New Jersey is the second most profitable state for operating purposes.
I don't understand that.
Well, okay, well, I will, and I was interested in that revelation as well, and we're going to go into it as well. But the idea that we're paying the highest rates, which we apparently are, we're operating allegedly by the Commissioner's observation, who theoretically ought to know, in a state that is the second most profitable to the automobile insurance industry, and we can't find insurers who want to come in and insure, and the perception is that the rates are extraordinarily higher than they should be by the general public. All of those things just do not mesh, and I'm sure that, at least I think, there must be some explanation, but I'm not sure I fully understand it, and I don't feel too badly because apparently nobody else understands it either.
Well, there are two parts of the problem. One is the underlying cause that produces high costs of insurance in New Jersey. And that basically has to do with a very expensive no-fault system without taking anything out of the tort system. It's very, very expensive. And then you impose upon that a regulatory scheme that has artificially repressed rates. A large number of insurers have withdrawn from New Jersey, either formally or informally. There aren't many left. They've created the Joint Underwriting Association to take the business because insurers don't want to write it voluntarily. Our State Farm agents, and we have a large number of them in New Jersey, place much of their business with the Joint Underwriting Association. We anticipate the Joint Underwriting Association will be broke, out of money, in the coming few months. Then it's moment of truth time, and the question is, can New Jersey deal with the underlying cost and give insurers a regulatory climate where they want to sell in a market as you describe it?
Let me get off of being too provincial and get back to a general approach to this. Mr. Irving, let me ask you, you reinforced Mr. Ingram's point about the competitive parts market being a beneficial development in the area of controlling costs. What do you do to make sure that you're not gaining benefits on the one side from the competitive market and resulting in lower costs, while paying out more if, in fact, those competitive parts happen to be from stolen vehicles, so that you're paying it on the other side? Do you have some process by which you even pay attention to where the competitive parts come from? You do accept my premise, don't you, that if, in fact, you're getting a benefit from a competitively priced part in the cost of repairing the car, but you're paying out because that part came from a car that was insured by somebody whose policy you held, you have paid on the one side for the benefit that you've gained on the other side.
Well, if I understand your question, you're asking me how do we ensure that the parts we pay for are legitimate parts and that are put on the car? Is that? And
don't you have an interest in making sure that that's the case, because it may very well be a part that came from a car that you had to pay on?
All right. Yes, we definitely have an interest in that. That's part of our reinspection program. And, you know, frequently when our supervisors go back to a body shop on a supplement or to take a look at the work that our adjuster has performed, we'll examine the estimate and the money that we've paid to see if the car has been repaired and all of the parts that we've paid for have been put on, or if they're new parts. And frequently we will find that we've paid for a new quarter panel, but it was straightened, it wasn't replaced. Or we will find that we've paid for new parts and used parts have been used.
Any effort to make a distinction between used parts legitimately come by versus used parts stolen?
It's very, very hard for us to tell in the adjustment process where any repair facility obtains their parts and if they're legitimate or not. And we're not at the point where we can demand invoices and backtrack and that type of thing. I did. You had asked earlier about you know, why the overall costs of auto insurance keep increasing despite all these things that that we're doing. And I just wanted to make the point that when you talk about auto insurance in general, that the impact of injury claims has been very, very significant in recent years. And as I understand it, and this is not my area of expertise, but the inflation on the medical aspects of claims, the rate has far exceeded the average inflation rate in all other areas. It was up to like 13% when the economy was up at 4%, that type of thing. But looking more specifically at factors dealing with just auto repair costs, the physical damage piece, we have done some preliminary studies, and it's very early in the game to talk conclusively about some of the trends, but we believe that the repealing of the 55-mile-an-hour speed limit is certainly a factor in causing more severe impacts and causing vehicles to be damaged at a greater rate. Certainly, the price of cars, new cars, as you had mentioned yourself earlier, is going up at a much greater rate. And the cost, the labor costs that repair facilities charge have gone up at quite a remarkable rate in the last year or two. Now, you have so many things at play here that these tend to offset some of the actions that we can take in other areas to hold down the cost. If to reverse it, if we hadn't been able to do these things, the rates would be up even more.
Let me ask just one last question, or want to develop this one last area. You heard me earlier make the representation that 65%, on an average, 65% of the auto premium is returned to the consumer for various purposes, and that 31 cents of that was for automobile repairs. That came from the 1987 bests, aggregates, and average yields. Can I ask what your specific, if you know, what your specific experience is in terms of the premium dollar, what the breakdown is in terms of the various components?
Between vehicles and people?
Well, I'd be interested in terms of the breakdown that we have is 35 cents for administrative costs and profit, 65 cents for payout to the consumer, the purchaser. 31 cents of that 65 is for vehicles. Presumably the balance is for health costs, lost wages, things of that sort.
If you take all of our claim dollars that are paid for vehicle damage to property, approximately 75% of it is paid in claims.
Well, that's not helpful. Work from a premium dollar.
Mm-hmm.
What percentage of the premium dollar goes for automobile repair, whether it be paid to the individual because he's going to fix his own car, or paid to a repair shop?
60% of all the claim dollars go to pay for damage to property. The remaining 40% is for bodily injury.
Well, I mean, you get something out of, I mean, the company is not, philanthropic.
Well, if you talk about how we divide our dollar between claim payments and expenses.
I guess what I'm trying to do is just to make it neat so that I can understand it off of what the best system has done. What I'd like is a breakdown of the dollar between what is required in terms of the payout in the various categories, what the company keeps, administrative costs, profit, taxes, whatever. If you have that sort of analysis, particularly on the car repair cost component, that would be helpful.
Well, looking at 1987 experience, if I understand the question, 75% would go for damaged vehicles. The remaining 23%.
75% of what? Of your premium dollar?
Yes.
Okay.
23% would be for expenses.
Expenses for the company?
Yes.
Right.
And in 87, we had an underwriting loss of 2.5%. So.
Okay, so you're talking about underwriting as opposed to the totality of the dollars and so on.
Right.
Let's do this, if you don't mind. If we frame a question and we submit it to you in writing to try to get us some sense of these breakdowns, we'd appreciate you responding to us.
Yes, we could do that and quite promptly.
Fine.
Visit with my friendly actuary here. I can get an answer quick.
Let me express my appreciation to both of the witnesses, and thank you very much for your participation.
Thank you. I did have just one other comment, if I could. I had meant to mention that we have a handout from the Alliance dealing with replacement parts costs, and as I understand it, it's not quite ready to be released, but I wonder if we could submit it later, if that would be of interest.
We'll be happy to receive that. We'll make it part of the record.
Thank you.
Thank you very much. We're going to move very rapidly to our next panel. Okay. Our next panel is made up of, and we're pleased to have back before this committee, Mr. Donald Randall, the Automotive Service Association. He is accompanied, I understand, by Mr. John Schnee of the Evergreen Auto Body Repair Shop, Woodbury, New Jersey. Ms. Sheila Loftus, Executive Director of the Washington Metropolitan Auto Body Association, who I understand is accompanied by Mr. Jerry Dalton of the Craftsman Auto Body Shop of Falls Church, Virginia. We are pleased to have our witnesses here with us this morning, and we thank them for their patience for the course of the morning's hearing. Mr. Randall, we'd be happy to hear from you.
Mr. Chairman, with your permission, I'd like to add two names to the group that are now accompanying me and Mr. Snee. Mr. Bob Anderson is from Ohio and is a shop operator there and an officer in that state association. As Mr. Bob Lechte is from Pennsylvania, and I thought we would ask them to be along to answer any of the technical questions that may be generated that I'm unable to answer.
Thank you very much. We welcome the gentleman to our committee.
Each year, about 45 million motor vehicles are damaged. The American public spends about $27 billion, or an average of $800 per vehicle, to repair them. The National Highway Traffic Safety Administration reports the total economic costs for auto accidents to be $74 billion. My statement in full contains quite a number of attachments which I think answer a number of the questions that I heard the committee raise this morning. The auto insurers, according to the records that we have, return only about 65 cents of the premium dollar to the insureds, 35 cents going for profit and for expenses. The auto insurers insert themselves into the contractual arrangements between vehicle owners and the repair shop, thereby controlling about 90% of these repairs nationally. In recent years, the auto insurers have increasingly become the controllers and dominating force in specifying the prices to be charged by the repair shops to their customers, the vehicle owners. The insurers have also assumed the role of private regulators of the quality of the repairs by dictating the repair procedures and parts to be used. The insurer's role as the private wage and hour regulators unfortunately places the insureds, the vehicle owners, into the middle of a double-edged conflict of interest with the auto insurance carriers. The insurers, who are partially exempt from the antitrust laws and subject to rather ineffective state regulation, have their own profit incentives for setting premiums as high as possible and for keeping claims payments as low as possible. Most states simply have file and use rates which do not require prior state approval. Astronomical increases in auto casualty premiums over the past few years are well documented. To justify these increases, the insurers blame the courts, the lawyers, the doctors, the auto manufacturers, the parts makers, and the body shops. The insurers, most of whom are multi-million and multi-billion-dollar corporations, have instituted cost containment programs ostensibly for the purpose of holding down premium increases. In doing so, they have created massive bureaucratic staffs. Thousands of claims enforcers are trained to keep in place a claims settlement system that frequently intimidates the vehicle owners through the fear of escalated premium or coverage cancellation if unusual claims or excessive claims are made. The vague, convoluted insurance contract language leaves the insureds vulnerable to the insurer's policy interpretation and determination of the benefits. In most instances, it is only after experiencing the claim settlement system that the insureds are made aware of their diminished coverage due to the insured's interpretation of the company's policy as it affects their contractual insurance coverage. Moreover, the claim settlement enforcer's jobs appear to be specifically aimed at fixing and maintaining the prices charged vehicle owners, the insureds, by auto body repairers. The auto insurers have developed a system of claim settlement policies that subjects the motoring public to repairs that are, quote, commercially acceptable, end quote, in quality to the insurers. These repairs are often not quality repairs. They are frequently substandard and mediocre in quality. These insurance company controlled repairs meeting their approved rates using insurance approved times and insurer dictated procedures and sometimes substandard imported parts results in many motor vehicles being repaired to a level that does not make the insured whole. These less than fully restored vehicles, repaired to the standards set and dictated by the insurers, are not restored to their pre-crash values, and as a result, these vehicle owners suffer economic losses to their vehicles in depreciated value. I heard an earlier witness this morning talking about CAPCA, a program to help improve the level of quality of the parts that are being imported, the so-called competitive parts. Only 40% to date of those parts are inspected and are meeting those standards. That means 60% are not. Hundreds of millions of dollars are involved in the expenditure of purchases and the installation of these parts that are not of equal grade and quality and that are on our vehicles today and that have inflicted, in fact, an economic loss to those owners on which those vehicles have had these parts installed. Now, when it's 100%, then the injury there will cease, we believe. Neither the insurers, the states, nor the federal government utilize any organized or effective means for determining whether these 45 million vehicles have their required emissions and safety systems properly restored by these mediocre, commercially approved repairs. A nationwide system of impartial expert inspections following repairs would reveal the quantity and the extent of economic losses from these less than fully restored vehicles. These inspections could be performed in connection with the national emission and safety inspections that are now in place or that are being planned. They could benefit the entire motoring public and the owners who are not skilled in judging the quality of the repairs by assisting these vehicle owners in making sure that they are properly restored. The average vehicle owner does not possess the expertise to judge whether the vehicle has been correctly restored. Most owners merely inspect the paint finish and interior and accept the more important mechanical or structural repairs with little or no scrutiny. Where the shops are forced to repair to the insurer's commercial standard, there may be additional repairs amounting to several hundreds of dollars that are needed, yet they cannot be performed where the insurer refuses to pay or requires procedures or parts to be installed that are at unrealistically low rates. If the needed restoration amounts to $500, and that is not an uncommon number, the vehicle owner, even if aware of the loss, can usually not find an attorney who will file suit against the insurer because the amount involved is too small. Most do not even know that they can invoke binding arbitration to have their vehicle restored to their pre-crash value, which the policy provides for. If only half of the 45 million motor vehicles involved in accidents are returned to their owners in less than a fully restored condition, and the loss value is only $100, the total loss is in the billions to the American people. Certainly the substandard costs, repairs cost less in claims payouts. And when they use, as I heard an earlier witness say, in-house adjusters who contain the losses and reduce the pay losses, that is accomplished. The cost containment by this army of enforcers are holding down claims payments, but the cost to the motoring public of this private, artificial price control, price and wage repression is enormous. Based on more than 20 years of my own personal experience in investigating the automobile industry, including service on the Senate Antitrust Committee, in which we conducted investigation of the insurance industries in the 1960s, I estimate that the economic loss to the public would be several billions of dollars. In the interest of brevity, I'll skip the rest of mine. I would say, in conclusion, Mr. Chairman, that our national experience, except in time of war, has demonstrated that government wage and hour controls breeds inefficiency and corruption. This current insurance scheme of private wage and hour control is equally detrimental to the motoring public. A large percentage of vehicle owners are forced to accept commercially approved repair jobs as dictated by these insurers, and they suffer an economic loss as a result, in my opinion. A survey of collision repair inspections and a system of inspections for vehicles after they've been repaired could measurably reduce the number of instances where the vehicles are inadvertently or intentionally not repaired. And I would conclude by offering for the committee a comment about your first panel this morning and the vehicle inspection issue. We have prepared, and I have provided to the committee staff, a survey of all the studies that relate to vehicle inspections that have ever been done in the United States that we are aware of, and several in the European continent that are included in it. Measuring by the least efficient technology available the savings in lives and injury that could be accomplished through vehicle inspection, there would be at least, under the old technology inspection criteria, about a 9% savings. And if you would look at attachment A to my statement, you will see that in that I have applied that savings against the NHTSA release on the numbers of death and injury and economic cost, and the savings are enormous. Not marginal, but enormous. We don't have enough information. We need more, and we thank you, and we are prepared to answer any questions that the committee may have.
Thank you very much. Appreciate your very succinct presentation. Ms. Loftus?
Yes, thank you for giving me the opportunity to speak before this committee today. My name is Sheila Loftus, and I am the Executive Director of the Washington Metropolitan Auto Body Association. And testifying with me today is Jerry Dalton. He's the immediate past president of that association and owner of 3 collision repair facilities in Northern Virginia. These are my observations concerning the high cost of auto repair as it relates to the collision insurance industry. 4 things have contributed to the rising cost in auto collision repair. The first is the design of the car. The second is consumerism. The third is the high cost of parts. And the fourth are the hidden costs, which also includes the way the insurance companies do business with the collision repair. Let me elaborate further. When Congress mandated that the car manufacturer build more fuel-efficient cars and sustain the 5-mile-an-hour hit, and then it later changed to 2.5 miles in 1983, the cost of repairs went up. To accommodate that fuel efficiency thing, Detroit started manufacturing what we call the unibody cars, as opposed to the big, heavy frame-type cars. Those lighter unibody cars are more fuel efficient, and they also are designed to crush in the front and crush in the back to protect the person in the passenger compartment. Well, the older frame-type cars had a bumper on it that served as a guardrail, and it protected the parts of the car. The bumpers themselves now on these unibody cars are more expensive. They're more complicated, more expensive. And the older frame-type cars, a 10-mile-an-hour hit on a frame-type car, you could drive it into the body shop. With these unibody cars, a 4- and a 5-mile-an-hour hit, the car has to even be towed into the shop. And the second consideration, as I said, is consumerism. The consumers are fussy. They pay $14,000 for a car and they won't tolerate a scratch anywhere. For example, a bumper cover that has a scratch from the accident, a consumer wants it replaced. It costs $300 to replace that. Chances are it's going to get scratched anyway. Also, a molding, which to replace it is $80. And also, the third reason for all these skyrocketing repairs are the cost of the parts themselves. And I have some examples. The 1985 Chevrolet sealed beam headlamp, which sells in any part stores for $650. A sealed beam, which is just the headlight, for a 1988 Mazda 626 costs $262.50. And a parking light for that same vehicle is $78. Normally, a parking light would cost about $18 to $20. Another example is the Chevrolet's economy car, the Cavalier. The headlight glass alone for the Cavalier costs $114. If you want the light bulbs, that's an additional $25, and the entire assembly, which includes the glass, the bulb, and the mounting frame, is $180. The door glass for a Ford Taurus, that's for models 86 through 1988, is $272. The heated windshield for that same car is $1,288.80. And would you believe if you owned a Lincoln Town car years 1980 to 1988, if you needed to replace the sunroof glass on that car, the glass alone is $1,817.95, and then it would cost an additional $200 to put it in. The insurance industry has told you about these aftermarket body parts, which are coming into in large quantities into the country, mainly from Taiwan, and they've been coming in for the last 3 years. The idea is good, but it doesn't work. Mr. Dalton's going to explain why it doesn't work, but these parts may be cheaper on certain things where there's competition. These parts are cheaper, but other parts have gone up, and the example was that Mazda sealed beam. Another example to support this statement is a 1988 Ford Escort. The headlight sells for twice as much as the fender now. The fender is $62.93, where the headlight is $121.57. And we have brought some parts here, and Mr. Dalton will show you those.
The first example is this Mercedes-Benz headlamp door and parking light assembly. It's just a bunch of plastic. You can all see it. There's not much to it. Cost on that is just $371. If you want to pass it around up to them, you can take a look at it. That's $370, guys. This little piece of plastic, there's not very much to it here. Comes off of a 1988 Toyota Camry. It's just a little $35 piece, and as you can see, there's not much to it. Now, those are foreign parts, and so you expect those to be fairly expensive. This part here is a genuine American part, good from Detroit, a little piece of plastic, goes around the tail light on a Oldsmobile. And you can see it's not much to it. It's broken, by the way. This goes around and comes all the way around. This is only $45. This is just a little trim that goes around your tail light. Your tail light costs considerably more. Now, that doesn't really tell you the totality of what we're dealing with in parts. Those are just a few items. Those may or may not be more expensive to cover up some of the other costs that they have lost to, that the OEM people have lost to the aftermarket people in Taiwan and elsewhere. There's a lot of other hidden costs too besides the parts, and I'd like to deal with those just a little bit first, because they're important, and they're important to our shops and our workers and everything. EPA has become very active, and they require waste management things now that we didn't have to deal with. This is one of the reasons. Another reason is lately OSHA's come out with a mandated program that we had to have instituted on the 21st of May of this year with right to know to all of our employees. Every material in our shop, plastics, thinners, right down to the last little drop of ink in our inkwell, has to have a safety data sheet. We have to educate every one of our employees on all the chemical hazards of that and all the hazards of every material in our place of business. This costs a great deal of money. We have to pay people to get the data sheets together generally. We have to pay people to come in and give the programs. And we have to do it on an ongoing basis. That's just one of the costs. Now, I heard Mr. O'Neill early on with his graph showing that the cost of the repairs skyrocketed even on small cars and all that. Well, part of the reason that a small repair can cost so much more now than it used to is the acid rain we're having and having to deal with. It's caused us to completely change the paint systems that we've had to deal with in the last 10 to 20 years. 20 years ago, we could have a very simple paint system. It didn't cost a whole lot to repair the vehicle with it. You didn't have to have sophisticated spray booths because there were not isocyanate poisonings in them like there are in today's paint. But today's paint has to be harder. It has to withstand more than it did even 10 years ago. There's a cost in there that is pretty astronomical just because of our environment. Another cost is the way we, as a repair industry and as the insurance industry working with us, do business. The present claims system causes enormous amount of lost clerical labor hours, just lost downtime in the shop. I'll give you an example. Years ago when I first got in it, and a State Farm adjuster would come by my shop, I would write the estimate on the vehicle. He would go over the estimate, and if there were things that he felt was unreasonable on it, he would cut them off the estimate. We would get an agreed price. Check would be there. We could get the car fixed, and that would be it. Today it works a little different. A consumer gets their car in an accident. It comes into my shop. He calls his insurance company. There are exceptions to this, but I would say this is 90% the way it works right now in the Northern Virginia, Washington, D.C. area, and probably all of your large metropolitan areas. The estimator comes out, looks at the car, brings his check sheet in, checks the things off on it so that he can go back to his office and run it through his computer. It gives that sheet to another employee in that office. They read off the sheet, input it into the computer, and get us a computerized estimate. Now, it would work pretty good if we had the computerized estimate right then. But they drop it in the mail to us, and we'll get it probably in the next day's mail, assuming the mail is working, assuming the secretary sending it out is not backed up, assuming the adjuster gets in there on time to give it to the claims department. That's a minimum of 3 days downtime with nothing being done to the vehicle. Now that's just a consumer loss because that doesn't hurt me except in lost space. My shop is cluttered up. I'm not making any money on that job while I'm waiting. But then the fun part starts. Because with the computerized estimates now and the computerized systems that they have, like parts exchange, parts assembly locator, things of that nature, when they get that back to the office, they're going to tell me what kind of part I need to put on that car. They're not going to discuss it with me necessarily while they're in the shop. They're going to tell me, you're going to have a used fender on that? Maybe. You're going to have an aftermarket fender or an OEM if nothing else is available. If it's an aftermarket, until recently, and in some cases, a lot of the insurance companies are still doing this, they're going to tell you exactly where to buy that aftermarket fender so they can get the cheapest price from it. If it's a used part, they're going to have the number of that salvage yard you're supposed to buy that used part from on there. And if you deviate from that, then they don't take any responsibility for it at all.
Mr. Dole, let me ask a couple of questions. I get the general drift of the point that you're making. Let me just ask you and some of the other witnesses here.
There was an end, though.
I'm sorry?
There was an end to it.
Go ahead.
No, go ahead.
No, go ahead.
When an aftermarket part is used, we get it out. It's of inferior quality because it's not certified, because CAPA is not fully functional now, and CAPA will be a good thing when it gets functional. Then we have to call back on the supplement. The same routine goes through the supplement that went through on the original, and so conceivably you can be down a week or more with nothing happening to that vehicle, just taking up space in my shop, the consumer being without it. And it's just a dead loss there. It's a hidden cost that has to be passed on into labor rate increases.
I guess what I'm trying to do is to cut to the bottom line in terms of what's Plan 2. Now, the thrust of what it is that most of you have said is that, in fact, you're not adequately being compensated. That appears to be the point. And it may very well be that you're 100% correct. And I am sensitive to the point about the new training that's required. As I said earlier, I've seen some of that. But again, in the same way I responded to the insurance people, you have a hard sell if you go out and tell people that they're not paying enough for insurance, whether it translates into the need for higher rates to have higher costs passed along back to the insured. Let me just ask a question of all, particularly the professional people here. What percentage of your business is auto insurance generated?
The majority.
90?
55%.
Majority.
Of the 111 jobs currently in process, insurance is paying for 84.3% of them.
Okay. I would think that would reinforce the point, though, that the insurance people would make, was saying, fine, we're doing our best, and it may be totally incompetent, it may be insensitive or whatever, we're doing our best to try to get some control over these things. And let's assume that the vast majority of people in the business are reasonable, legitimate business. There is always in any business those folks who will take advantage if they're given the opportunity to take advantage. I made reference to the article in today's Post that I'm sure you read. One last week talked about, again, it was in this area, no correlation between cheaper service and better service. In some instances, there were people who were providing better automobile repair service who weren't charging as much as people who were charging more and providing less adequate service. I guess what I'd like from particularly the people here who are in the business is what their suggestion is for the alternative to try to make sure that we do, if you don't want a governmental system, and I suspect most people don't want a state governmental regulatory system overseeing repairs, what is it, in absence of the insurance industry playing this policeman monitor role that you are unhappy about, what is it that's the second choice? Let me ask these gentlemen, if anyone has any thoughts as to what Plan 2 is. Yes.
Free competition. The insurance industry dominates our business.
Right.
We cannot charge what we want to charge. We have to charge what they're willing to pay in hourly rate and in parts, as the gentleman over here alluded to. You have been misled by some of the statements from the insurance people. State Farm, when they spoke earlier, indicated that their insureds have the freedom of choice of their own shop. Prudential made no mention of that. Prudential directs the work. They have their referral shops who are willing to do the job their way for their price on their customer's car. The other point that I might make is that the aspect of free competition, the problem that we have is there is no incentive for the independent body shop or dealer body shop to invest in this business because we get the same price no matter whether we have a great big facility or we have a little tiny facility. Now, when I say the same price, I mean in dollars per hour, hourly rate. So there's very little incentive. As you alluded to, you've been to the vocational schools, and seen people in training, but not in our trade. Our trade has been primarily forgotten about because there is no money for future employees to come into it.
Where are those young people going to work then?
Every other trade, every other service business you can imagine.
No, this is specifically automobile repair training operations that folks are going out of the school getting $30,000 a year.
Primarily, that is not the case. Okay? They may be in the mechanical aspect, but not in the body aspect.
Okay.
Which would be insurance correlated. Okay? And if you would look at one of Mr. Randall's attachments, you'll find hourly rate charges around the country. And ours is a very suppressed business. And I think that the insurance companies try to keep us that way because it keeps their costs down. And I understand what they're trying to do, but soon there will be no workers in our business. There will be no places to get cars fixed because we will not be able to have competent employees and we will not be able to afford to stay in business.
Does that mean that the automobile manufacturers' outlets will be doing the work? That is, say you go back to your Chevrolet.
They don't want it. I mean, they don't have it.
It's such a difficult business to make a profit in. They don't want it because it requires a great deal of hands-on supervision. And a lot of agencies are absentee owner type of operations.
Mr. Florio, at the rate of oversimplification, what we are suggesting is if the insurance industry would be in the insurance business and not in the business of being the wage and hour regulators for which the American people are paying billions of dollars for this system.
And play the devil's advocate, aren't they going to tell you that if we didn't do this, we'd be paying much more and the American people would be paying much more?
Well, that's not so. If they shifted the money out of the bureaucracy for administering the program and put it into repairing the cars and let competition work, it works beautifully in this country in most industries. This industry is one of the few that is privately regulated. And we learned from the era of when President Nixon was in and he instituted wage and price controls, our economy got into a shambles. It's a terrible mess. We have it here in this industry right now. And we have a shortage of technicians. We have hourly rates that are significantly below the mechanical rates, hourly rates that are dramatically below comparable skills in other industries, and you have a flight of technicians away from this industry into those others and a shortage of those in this industry, and the quality of repairs suffers as a result of it.
Are there substantial differences in the way that various insurance companies approach this issue, or is the system pretty much uniform?
Yes, it is, but the
yes, it is what?
It is. There is a substantial difference among the companies, but the system generally flows at an even level, and you have what is known in the trade as a prevailing rate, and Mr. Schnee alluded to it. You have shops that have a very expensive equipment, highly skilled technicians that are paid the same hourly rate as a slot shop down the street that is known as an alley shop that butchers the cars and returns them to the insureds in a half-repaired state, and then they have to and the insurers have to wind up paying our people to correct these misdirected, butchered repair jobs. That kind of thing happens. And we could go on with many, many horror stories, but I would end just quickly and say that when you have a system that applies a mediocre price, a price that is a artificially suppressed price, and you pay that price to repair a Cadillac, or you pay that price to repair a BMW who wants it really repaired, or you pay that same price to repair a Pinto, something is wrong. Competition isn't working. You have an artificial system that is breeding dissatisfaction.
Ms. Loftus.
Yeah, just to help answer that question about how the insurance companies deal, and they do basically deal the same, and it's State Farm that does the prevailing rate, and because State Farm is so big, in this area, we're at $22 an hour. Every single other insurance company is at $22 an hour. State Farm doesn't have to be in the grouping with that, what was it, the ISO with everyone else, because they are a grouping of their own. They're so big. And so regardless of how a shop is equipped or not equipped, it's that across-the-board prevailing rate, whatever State Farm says, by every single insurance company, with only a few exceptions. And I do have a suggestion, though, of how things might be different in the body shop business, is that not all body shops are equipped the same and able to do the heavy collision repair. Some can do it more efficiently, more economically than others, and others could better do the light bumps and hits and set up that kind of, and they do it in Europe that way, and they set up that kind of system. That would be much more efficient.
When you say set up,
that would we have to do in our own industry. And there are, we have groups within our industry working
at... Very careful. I mean, it's only the insurance industry that has the ability to allocate decisions like that. You go to jail if you decide to set up different...
But that
no, that would be an industry type of thing, that our own industry, we're trying to define what we even are.
No, I'm not being semi-serious. I mean, it just, start steering people to different companies or different shops in accordance with an industry-determined allocation.
Yeah,
I suspect your lawyers will tell you that there may very well be some problems.
We know about antitrust.
We're well aware of our antitrust problems.
But competition would develop that kind of efficiencies in the industry.
Let me just conclude, because we're required to vacate the room at this point, by saying that I really do appreciate, particularly the people who've come from a distance to come and participate in our hearings today. It's extremely important that we get that type of hands-on insights into these problems. And the statements have been reviewed and read in depth by the committee and the staff, and that the representatives of the national organizations are certainly to be commended for representing their constituents very well. But I particularly thank people from coming in from the field to be here with us today, and I want to thank you very much. The committee stands adjourned.